Greetings, traders. It is I, Abdul Shabazz. This is some real change stock options trading journey. And today, this terrific Tuesday, January the 27th, I can't thank you guys enough for tuning in and being a part of today's show. Let us keep in mind as well as remember that tomorrow is FOMC, and because of that, I will not be trading today. That's not saying that there won't be any moves today, but I am going to follow the majority of big money who's simply going to wait for the report to come out tomorrow, see what the market is doing, and then make the necessary adjustments. I will be following that same scheduled mind frame. Expect to see 700 this week, potentially and possibly. Todd Macon, shout out to you, buddy. Todd, more than likely I will not be trading today. FOMC tomorrow. MYM is in the building. Jared is in the building. Team, we have FOMC tomorrow. Let me show you guys that here real quick. FOMC interest rate decision tomorrow at 2 o'clock. Fed Chairman Powell will be speaking at 2:30. Today is a no trade day for me. I will not be trading prior to FOMC. Rather, I will be following big money myself and waiting to see what the decision is and then what the market has decided after that. Expecting to see 700 this week, but I will not be trading today. Rather, I will be observing and gathering information. I'm going to open this morning up at 694 area. So I'm not going to even include pre-market, except for what's here on the left in the 2-minute chart. I do have pre-market up, and you can see exactly where we're at. But again, I will not be trading today prior to FOMC. Very important interest rate decision is coming up tomorrow. Going to have a profound impact on the market. We'll still be calling out live commentary today, but I will not be taking a trade today. Live commentary until 11. All right, that's what we're gonna rock and roll with. We get some news up, see what the news is talking about. S&P 500 attempts fifth straight gain after a majority of its components started the week higher. Just dipped below the 694. Just dipped below the 694. Could definitely see a move back down to the 692.5 area. That's definitely possible. Just gonna be patient. Let's see what the market does today. Nine minutes, we'll be getting started. We're so close that I'm not going to have a pre-market for the 5-minute chart. We're just going to go right in the market open. Be back with you guys in 8 minutes. My sentiments exactly, teammate. In Kosi, I just said the same thing. Jesse Swanson's in the building. Ignificent from Kick is in the building. Thank you for checking out. Hope everybody is feeling well. Jesse said low volume on the SPY. Looking for a run at 700. Probably won't happen until after FOMC. I said the same thing. So much so, Jesse, I'm not even trading today. So I already told the team that I'm not going to trade today, the day before FOMC. Instead, I'm going to follow Big Money and do like Big Money is doing. You know, wait and see what FOMC, what goes down with FOMC, and then we'll make our adjustment, you know, after that. So that's where I'm at with that. And I'm looking for 700 as well, Jesse. I expect the SPY to hit 700 this week. I still expect it to hit 700 this week. I just don't think it. Who knows whether it be today, but I'm not going to be trading today. I'm going to wait until the big boys make their decision and then come after that. Looking at a possible pre-market high call. And Kosi said, all right, I like that. Thank you for putting that up there. I'm going to put your marks up here today, and Kosi. Thank you, teammate. And Kosi said you're looking for a possible pre-market high call. All right, I got that right here at this 695 1 area. So I'm going to go ahead and put an alarm there. All right. Got an alarm there. And Nkosi is saying he's looking for a put below 693. I'm going to put an alarm there as well, Nkosi. Thank you, sir. All right, now the team got something to go by. And I didn't want to include pre-market on the 5-minute chart because of us being so close to where we traded yesterday. Yeah, we dipped off at the end of the day, but that really was of no significance. Key is going to be to look at the higher time frame today. Let that higher time frame be your guide. Clearly see this overhead resistance here on the 2-minute chart to the left. Brooks is in the building. Good morning, team. Hope everyone is well. I'll be here in the background. No plan to trade during news. I just said the same thing, Brooks. We all are on the same page. It's professional move. Now, that's not saying that there won't be profits today, because there's profits to be taken in the market almost every day. However, with us attempting to become more and more professional in our trading, we realize that with the low volume, you're not going to have a lot of follow through. You can have some possible whipsaw, some chop. And with the low volume, that's not very healthy for trading options. Please trade based upon your comfort level and your understanding. And Nkosi has given us calls above 695 and puts below 693. I myself am not trading today, so I'm asking the team for their thoughts and what their plans are. And so I've gone ahead and I have put that up on the chart. I will be in the background myself, but I'm going to allow the market to do what it does today. We'll have the news up just for giggles. S&P rises as traders await big tech earnings. That's the news as the market bell went off. Again, I will not be trading today, but I will be in the background providing commentary until 11 o'clock. Thank you all for tuning in. And thank you, Team Kick, for kicking it with us as well. Alrighty. Let us be entertained. Brooks, that's crazy. I was just looking at some of my old videos, Brooks, as I was going through the year, looking at my year in review, all of my trades that I took last year. As you guys know, I have a copy of every trade I have ever taken. We're dealing with options. And this is going on my third year now. And Brooks, I remember when the SPY was crossing over the 500. And now here we are closing in on 700. Somewhere along the lines, we're going to have to put some money in some long-term leaps. This is America. The SPY is going to go to 7 to 8, at least with 47 in the office. I don't know what's going to happen after 47, but with 47 in the office, you're going to see some numbers you ain't never seen before. So maybe that's something we could talk about, on the side as far as expanding our playbook. But we definitely got to get some of that leap money in there. Dr. JB is in the building. Shout out Dr. JB. Dr. JB in a nice call right now. Also, this is that Arian Kosi called out earlier, guys. If you remember the break of the pre-market high. Good job, team. Yes, sir. Don't play with it, Nkosi. Don't play with it. You know, we ain't got a whole lot of follow through. Low volume. This could be the break and retest. However, you want to look to the higher time frame right now. And on that 15-minute, that first 15-minute candle wicked out at the top of the 695.48. The second one is doing the same right now. But this could be a pullback as well, as long as she stays above. You feel me? As long as she stays above the 695. In my opinion. As long as she stays above the 695. However, we've just gone red. So you got to look at the higher time frames as well. Don't play with it. We know it's low volume. This is also a reason why I'm not trading, team, because I don't like the follow through. We don't have the volume to give us the follow through on any move that would normally be a great move. So, again, a lot of big money is waiting for FOMC tomorrow. I am waiting for FOMC tomorrow. That is not to say there will not be any good scalps. This is a great put scalp right now. This is a great put scalp right now. Beautiful 5-minute shooting star at the top. Two of them back to back. Price trading underneath it. Putting all this pressure on the 950 bulls to cover. Price coming back down to the 694.5. Bam. That's a scalp. That's a scalp. You see it over here, Dr. J, even on the in the Heikin-Ashi, Doji, 1, 2, 3. Blah. Is it sustainable? That I doubt. That's one of those type of situations you got to already would have been out of it already. If you caught that, you already have been out of it. Typically, you know, you could go that first 5 minutes, let that profits be in that first 5-minute candle. But on a low volume day like today, you just can't expect normalcy. So who knows what could happen? She might drop all the way down in one candle to 693. Who knows? But because of the unnormalcy, that's why in situations like this, you got to take that money when it presents itself and get out of Dodge. And even if you took that call, it was a beautiful, beautiful call, beautiful scalp. He said he got out with 6% like a professional. Like a professional. Great job. Great job. But again, this is what low volume does. It'll give you some opportunities, potentially, but just realize you can't marry them. You got a one-night stand them. Another example of what I'm talking about as far as not getting that follow through. That's why I said you would have had to get out right there at 694.5. Not getting that solid follow through in either direction, but also this could be, I don't know what it is. Because even if you were bullish, I mean, that type of pullback, you know, that was a crazy pullback. That's why I was telling Nkosi, you know, protect yourself. That was a crazy pullback. So a 6% win is better than a 2% loss. Shout out, teammate. Beautiful work. And you can always get back in. You can always get back in. And this is looking more solid. Looking at the clock too, I personally will wait until 10:15. I would personally wait until 10:15. 5 more minutes to see if you're going to get this continuation move. And if so, look for it on a higher time frame, not the 5-minute. Preferably the 30-minute, but intermediately we have the 15-minute. At least that'll give you your third candle on the 15-minute chart. But early, trying to, you know, snipe guys, you know, really, for real. Even if you are going to trade today and have the desire to do so, it wouldn't do you any harm if you waited till this afternoon. Really gave the market some time to move. Really allowed somebody to be able to get in trouble, where you could identify who they are, where they would have to cover at, and then lay in wait in that area. Stay out of this mess. Protect yourself. Talk back with you guys in a minute. He said, I'm going to the bank and I'm going to see if I can make 6% of my money in 15 minutes. If I can make a 6% return on my money in 15 minutes, Bank of Nkosi, yeah. Yes, sir. Come on, somebody. Beautiful. Absolutely true. You better recognize, like I said, a 6% win is better than a 2% loss any day. But when you put it in that perspective, not even a bank is going to give you a 6% return in 15 minutes. Indeed. Thank you, Nkosi, for that, sir.
Fiscal risk concerning at the long end. I mean, is that something we're going to be dealing with throughout this year and next year and on from there? Or do we ever see those risks actually realized?
It will probably be until you and I retire.
Right.
So I really mean that this is not going away anytime soon. So the challenge, of course, is what is exactly where on the curve is issuance going to take place. In the front end, is it T-bills, is it the belly, is it in the long end? And in the long end, there's now more and more demand from other sources of privately issued long duration. So the main buyer of long duration normally is pension and insurance. They would normally used to buy 30-year treasuries. But now pension and insurance buy long duration privately issued assets in
Private
data
credit,
centers,
right?
private credit.
Yeah.
You have infrastructure, you have energy transition, you have climate. All those long duration privately issued assets are now competing with 30-year treasuries. So that means that there's structural downward pressure on the long end of the U.S. Treasury curve.
You think the market can live with the asymmetry between sovereign debt and corporate debt?
Well, the key issue now with, of course, a lot of the corporate debt that is coming to the market is investment grade. It used to be that corporate debt, for a very significant part that came to the market, was high yield. But now you both have investment grade sovereign U.S. credit, and now you also have hyperscalers investment grade credit. So if you are a pension fund manager sitting around thinking about long duration, should I buy sovereign U.S. debt or should I buy hyperscaler debt? That's suddenly becoming a much bigger issue now that the amount of long duration debt coming both from private credit and from public markets from hyperscalers is growing as quickly as it is at the moment. So that's competing directly with exactly purchases of U.S. Treasuries.
Fascinating moment that we're in. We'll see what we get tomorrow out of the Fed, T. Thank you as always.
Thank you.
Torsten Slok.
Here's our roadmap for you for the rest of the hour. Still ahead, who is really bearing the burden of all the tariffs? We'll talk to the author of a study that says nearly 100% of the costs are being paid by U.S. consumers.
Plus, it has been exactly 1 year since the emergence of low-cost Chinese AI model DeepSeek sent a chill across the technology sector. We're going to talk to an AI expert about where things stand now in the race for AI dominance, of course, between the U.S. and China.
And after the break, insured losses, names like UNH and Humana tanking as the government looks to put a lid on some Medicare costs. We'll talk to an analyst about whether we should buy some of these dips when Squawk on the Street continues. Welcome back. Health insurance stocks under serious pressure this morning. UNH, Humana, CVS, all down significantly as the White House proposes keeping Medicare rates lower than expected for 27. Let's bring in Cantor Fitzgerald analyst Sarah James. Sarah has a buy rating on UNH and CVS, a hold on Humana. Sarah, it's good to see you again.
Thank you. It's good to be back.
We've been kind of getting used to dislocations like this in this space. Is this one any different?
I think this is another great opportunity to buy. We've got a dislocation in Medicare Advantage. Remember that resets in pricing every year. And I think when I look across what's happening to the stocks, it's really not allocating correctly. So you've got some companies that are heavily exposed to Medicare Advantage, like a Humana, but you have others that have a very consistent, strong pricing discipline, diversified book, like a CVS or a United, that are getting taken down with the group and really shouldn't be.
So that explains the hold on Humana. How do you expect this to get codified or solidified policy-wise?
We're hoping it gets better. Typically, in the next 2 months, there's going to be a revision and it goes up by a couple hundred basis points. But the backdrop of this issue is rates have been insufficient to cover costs for seniors for several years. And expectations were that this was the year, 2027, that things were going to start aligning and getting better. And instead, we saw CMS go in the opposite direction. And they've put in a few new headwinds that are debatable at best on whether they're accurately reflecting what's going on in the coding environment. So we're hoping that there's a robust conversation back and forth between the government and the payers over the next couple of months, and we get a positive revision. That said, we're not in the environment we thought we were going to be in, and it's probably going to result in some exits, which is going to be challenging for seniors come 2027.
Right. I mean, I've heard some industry players just say you're going to get less for less, and they're still trying to figure out this risk model revision cost, I guess, that you may be referring to as well, as sort of somewhat indecipherable. Let me come to UNH if I can, though, Sarah, because obviously we've got earnings this morning, so dealing with these headwinds on Medicare Advantage. But what about the medical loss ratio there and just overall sort of what you heard from the conference call?
I think the conference call went great. We've got a new management team in there. Well, returning very experienced management team. And I think they're setting the tone for guidance is conservative. We're going to be able to hit beat and raises. And they showed that out this quarter. They beat consensus by a slight amount. Medical cost seems relatively under control. We've got some optimism in a few of their segments for next year. So this is one we really like, especially on days like today, where it's selling off. Our price target's up a little bit over 30% from where they are today. We think this is a great buy for short-term and long-term investors.
Isn't this, though, a sign overall, which I think may be a source of uncertainty, Sarah, that the administration has moved on from the pharma industry, as the pharma industry has been pleading with them to do, into healthcare services as a ripe spot for, reform and cuts and making things more affordable for Americans?
Yeah, that's a great point. And we always have to watch it. They've had the payers up to DC over the last couple of weeks. United in particular made a concession to be willing to give back profits on one of their segments, the exchanges, as a goodwill gesture. And yet we see this continuing hardening. And the risk adjusters that were mentioned a little bit earlier, that's trying to tap down on what the government is wondering, could it be accurate? Could it be upcoding? Could it be fraud? It's our view that just because someone missed a code initially, but you've got the data in the files, doesn't mean that it's fraud. It just means you have to use technology that's available today to code accurately. But we are seeing this increased pressure, increased focus on payers, and that can get a little concerning. That said, we think post-elections, we're heading into more of a political gridlock situation, which is usually where the payers thrive, when there's less regulatory change. So this could be a great time to get reacquainted with some of these names.
Well, yeah, we'll see what happens. That's still a little bit of a ways off, Sarah. Appreciate the help on this one, though. Good to see you, Sarah James, on some health insurers.
Still ahead, exactly 1 year ago, DeepSeek's emergence sent tech stocks tanking. Remember that big sell-off, erasing a near $600 billion in market cap for NVIDIA alone. Have the risks abated or grown? We'll discuss. Plus, just who is paying for President Trump's tariffs? We've got the researcher behind a study that contradicts the administration's viewpoint. But first, what Boeing CEO had to say about the quarter as shares fall despite a revenue beat. We'll cover all of that for you. Don't go anywhere.
else, be honest, who else for a split second thought this screen was frozen? I really thought my screen was frozen. I had to look at the screen. I said, wait a minute, what is going on? And then I had to look at the time. I said, oh, it is still moving, but for a split second, I thought the screen was frozen. Go get the Bob.
We are 30 minutes here into the hour. Here are three big movers we're watching. General Motors driving higher today after an earnings beat, dividend raise, and announcement of a new stock buyback program, along with strong guidance. Stock up almost 8%. Boeing posting a quarterly sales jump year over year, and the company's highest annual deliveries since 2018. The Wall Street may be looking for guidance on the.
I think the important thing is that we saw free cash flow positive again in the fourth quarter, so that's really good news as we're starting this recovery. And we also saw increased rates in our commercial programs, particularly the 737 and 787. So I feel really good about the backdrop from 25, setting up a pretty successful 2026.
All right, bullish forecast there. And then speaking of bullish, watch Micron shares higher again after the company announcing it has plans to invest $24 billion in Singapore over the next decade to boost manufacturing capacity, adding guys to a now 350% stock gain over the last 12 months. That memory shortage is real.
Incredible. Approaching a $500 billion. I mean, it's a little bit, boys, but a $500 billion market cap. All right, time for a CNBC News update. Contessa Brewer has that for us. Contessa.
Hi there, David. Minnesota's chief federal judge ordered Todd Lyons, the acting director of Immigrations and Customs Enforcement, to appear in his courtroom personally Friday or face contempt charges. The judge is calling on Lyons to explain what he says is repeated defiance of judicial orders in the state over immigration detention. The demand came from a case of a detainee the judge ordered released on January 15th, but was still in custody as of last night. Opening statements are expected to begin today in the sex trafficking trial of luxury real estate agents Tal and Oren Alexander and their brother Elon. Prosecutors say the brothers used their wealth and influence to attack dozens of women over a 12-year stretch. Defense lawyers say the brothers only had consensual encounters. That trial is expected to last at least a month. And France's lower house approved a bill today banning social media for children younger than 15. It now heads to the French Senate, where President Emmanuel Macron has requested the legislation be fast-tracked. He called today's approval a major step in protecting that country's children. That's the news now. Carl, I'll send it back to you.
Wow, Australia and now to Europe. Contessa, thanks. Contessa Brewer. After the break, while tariff revenue has skyrocketed this year, who exactly is paying? We're going to talk to the researcher behind one study that argues you are. According's at the top of the S&P in early trade after inking this new deal with Meta. That story and a lot more when we come back after this break. The Fed's kicking off its two-day policy meeting in Washington today. Markets pricing in more than a 97% chance of no change to rates. That's according to the CME. Our Steve Leisman joins us this morning with the latest edition of our CNBC Fed survey. Morning, Steve.
Morning, Carl. Yeah, the Fed expected to keep rates unchanged today and not cut until June. Just 2 cuts priced into this year. That may reflect a better outlook for growth. Still, only modest gains are forecast by respondents for the stock market this year, with yesterday's close at 69.50. It's seeing up to 72.50, a 4% gain, and then just another, or a total of 10% by the end of 2027 to 76.53. 73% of our 36 respondents say stocks are overpriced in some way or another. Looking at the economic backdrop this year, you can see some pretty good strength from the consumers. It says 30% believe the consumer will be stronger this year, 42% about the same. That's good news because the consumer was stronger last year. But a big change in business investment, probably linked to the tax bill. 68% say stronger business investment, with 15% saying it's about the same. Another plus out there, behind the U.S., basically, majority of tariffs say Majority say the tariff impact is behind the U.S. 28% say it's ahead of it, and 14% don't know. The impact would be a 0.3 percentage point change in the consumer price index. Still, tariffs are seen having a negative economic effect. 71% say it's bad for growth. 88% say it will lower retail margins. 68% say it's bad for employment, and 80% say it means higher inflation. Uncertainty around the administration policies is the number one risk out there. The AI bubble, Trump, the president's efforts to limit the Fed's independence, continued high inflation, and tariffs round out the list of the biggest risks to the economy. Douglas Gordon from Russell Investments sums it all up, all these tensions out there, saying there's certainly no shortage of potential exogenous risk sources to capital markets. This comes, however, against a backdrop of seemingly waning tariff impact, good enough labor data, elevated but not worrisome inflation, and perhaps most importantly, still robust earnings. So the outlook for monetary policy and the economy looks like it's going to hinge on this tension between positive aspects of the tax bill versus potential drag from tariffs, and whether there's still more in the way of tariffs to come, guys.
I wonder how the Fed is going to talk about all of this starting today into tomorrow, and how they frame their outlook, Steve, for the economy and inflation and employment. They're all kind of big question marks right now as to what they're going to do ultimately with policy and keep cutting.
Yeah, and the difference, Sarah, as you know, between how the administration wants the Fed to react and how the Fed is suggesting it will react, I think you put your finger on a really interesting question. The administration wants the Fed to act prospectively based upon all the good stuff they think is coming. More supply, more growth, and cut rates, everything will be fine. The Fed, I think, in general, I think the center of the Fed is all of that may be true, but I will react when it shows up in the data and not make a not set policy based on a forecast of good things to come.
Right. Okay, Steve, thank you. Steve Leisman kicking off the Fed coverage with a decision tomorrow. We'll stick with tariffs. New study from the Kiel Institute for the World Economy estimates American consumers and importers are paying the brunt of the tariffs, covering about 96% versus just 4% by foreign exporters. One of the authors of the study joins us now. Let's bring in Julian Hinz from the Kiel Institute. He's also an international economics professor at Bielefeld University in Germany. It's great to have you, Professor. Where do you come up with these numbers?
Thanks again for having me. So the numbers are coming directly from U.S. import transactions data. So we analyzed millions of shipments, and the message is quite clear. So if you look at the data, import prices have not changed at all effectively, and that means that someone needs to pay the tariffs, and that's the U.S. side. So if it were also borne by the exporters, that would mean that they would lower prices. They haven't done that. That means that almost everything is paid for by the U.S. side, whether that's importers or consumers. That's something that we cannot say.
I was going to say, because if it was consumers, if it was a high number of consumers, you would see that reflected in higher inflation rates and a little bit of firmness in categories like coffee and jewelry and furniture. But overall, I mean, it's really been a story of services inflation, not as much goods inflation.
Well, there are colleagues from Harvard Business School who are looking at that part. So what happens behind the border in the U.S. And so they see that roughly 20% of the impact of the tariffs has been passed on to consumers until now, and so 80% are with the importing firms, and so that eats into U.S. Companies' margins.
Right. So I guess that what you're seeing is that foreign suppliers are not. I mean, because the argument the administration made is that foreign suppliers are going to eat it because they want to preserve their market share to sell into the U.S. market. You see that that's not happening?
That is really not happening. So the data does not support that claim at all. And so we've looked at this with the US data. You can also take Indian export data, and you see that the line is flat. They have not changed their prices. They have not tried to eat into their own margins to cover some of the tariffs. That is not happening. What is happening, though, and that's why tariffs are still bad news for the exporting countries, is that volumes go down. And so if you're an exporting firm and you want to sell in this big market, the US, it's more difficult now to sell to the US because US consumers, US importers are buying less because of the higher prices due to tariffs.
Which countries are getting hit the hardest on that front?
That varies really by how hard they're hit by the tariffs. And so India and Brazil currently are paying the highest tariffs. So it's 50% statutory tariffs. Effective tariffs are a little lower, but they're paying the highest tariffs. And then you have China somewhere. And so these are also naturally going to be the hardest hit countries.
Well, and where do you come down on whether, I mean, is the impact fading? In other words, do you think we've seen the worst of it and then things just level off here?
Well, if they stay, then I think it's quite clear that at some point it's going to be passed on to consumers because U.S. firms are, they like their margins. What could also happen is that over time, the exporting firms are going to say, well, we've had these long-term contracts, but until now, but now we are willing to renegotiate and going to bear some of the tariffs. What we do know from the earlier tariff period from the first Trump administration is that did not happen. So back then, there were much more selective tariffs on certain goods, but the tariff pass-through was effectively unchanged over time, meaning that tariffs were paid by the U.S. in the very beginning and until the end, and so that did not change.
Okay, well, interesting data. Thank you for sharing it with us. Appreciate the opportunity
to talk
through.
Thanks a lot for having me.
Julian Hintz from the Kiel Institute. Corning, the latest beneficiary of big tech's AI build-out, inking a new deal with Meta this morning. We'll tell you the details next. Plus, the CEO of $350 billion AI startup Anthropic out with a stark warning around AI's impact on society. Just the latest from him. And China's growing threat as well. We're back in a moment.
is glittering and silver is shimmering, but should you be chasing all the action behind that bling, or are there better ways to play that momentous metal trade? We're going to speak to a hedge fund manager who's taking a basket approach. Tune into our Market Navigator segment later on today on Power Lunch for more on that story, 2 p.m. Eastern Time.
Take a look at shares of Corning up sharply after inking a new deal with Meta. Seema Modi is here. She has details for us. Good morning, Seema.
Good morning, guys. So this is a $6 billion multi-year deal that will give Meta access to Corning's fiber optic cables, a critical wiring component used inside data centers. The deal signals two things. One is Meta's interest in owning a greater share of the industrial products and goods that go inside data centers, a trend that we've really been seeing across the hyperscalers. NVIDIA investing $2 billion in CoreWeave, Alphabet buying Intersect Power and Energy infrastructure developer, and Microsoft with that $40 billion deal with Align Data Centers. The deal also specifically has once again put the spotlight on the industrials that sell key equipment to data center developers. From the likes of Vernova, GE Vernova, Eaton, and Vertiv are all higher this morning. CNBC's Katie Tarasov got an inside look at Corning's facility. This is a 175-year-old company that at one point was considered a boom and bust .com era story. The stock, guys, has now risen 75% in the past 1 year. What analysts are saying about Meta, this specific deal shows us that it has this great intent to continue to pay up for ways to accelerate its AI ambitions, whether it's that $2 billion deal with Manus or that $14 billion deal with Scale AI last year, guys. The race is on. They continue to shell out more cash.
Yeah, I guess do we expect so the capex numbers everyone will be focused on when they report earnings? We expect those to continue to rise, and at how fast a clip? I guess that's key to the whole AI trade, right?
Yeah, I think capex will once again be a big point that we look for. I mean, all the hyperscalers, when they report earnings, will they be larger than expected? And if so, does that tell us that they have great ambitions that this return on investment will in fact pay off? And how much of that capex is also going to cover this interest in building and investing more in the industrial goods that are needed inside data centers? I was speaking to one developer in Michigan, and they were saying that it's so hard right now to get access to some of these key wiring and sort of unique industrial goods because of tariffs, because there's just so much demand right now. So once again, it's reigniting interest in some of these industrial names that may not be seen as quote unquote sexy, but suddenly they're seeing so much demand because of what they make and what they manufacture here in the US.
Yeah, we think so often about GPUs, but there are so many other things that obviously go into a data center to make it all work for the compute that's needed by these AI companies, to make it an AI factory, so to speak, as Jensen Huang likes to say.
And the energy, GE Vernova set to report tomorrow. I'll be speaking to the CEO as well about what they're doing to increase capacity.
Thank you.
Look for that.
Yeah, of course. We're going to be watching it closely. Seema Modi.
Thanks.
Speaking of AI, exactly 1 year ago, the emergence of China's DeepSeek, remember that? Erased nearly $600 billion in market cap from NVIDIA. We'll talk about what's changed in the past year in the race for AI dominance in just a minute.
All right, welcome back. It's been 1 year since buzz over Chinese AI company DeepSeek triggered a massive sell-off in some of the major technology stocks we follow closely. A different kind of warning on Chinese AI coming this week as well. Yesterday, Anthropic CEO Dario Amodei writing in an essay that the U.S. should absolutely not be selling AI chips and equipment to China, while also predicting AI will give humanity almost unimaginable power that, in fact, he's concerned it may not be able to properly handle. Joining us now is ex-IA CEO of AI consulting firm Mala Santo. Good to have you. Let's start off on a year since DeepSeek. I mean, it's not as though the Chinese have gone away. Where do things stand in terms of this race, that at least this race condition that people like to believe exists between our country and China?
Sure. So first, let's start off with DeepSeek. It's been a year since the AI model out of China was released, and it rocked the stock markets. And a lot of people are wondering if DeepSeek was a fluke. The truth is, no, DeepSeek was not a myth. It was just bad timing. Right before DeepSeek was released, they had announced Project Stargate, which said, we need $500 billion to invest in more infrastructure to scale AI. Right after, DeepSeek showed that efficiency was possible without scaling expensive hardware. And it scared the market into believing that NVIDIA wasn't sustainable. However, the efficiencies that DeepSeek drove have been adopted by every major U.S. AI lab, which has increased the drive for hardware because the efficiencies mean that we're able to scale faster. Now, as it relates to the U.S. versus China AI race, I think we need to separate the fact that both countries are taking two different approaches, where the U.S. is betting on equipment in order to scale AI, and China is betting on efficiency. Last year, Jensen Huang, CEO of NVIDIA, admitted that these efficiency techniques coming out of Huawei and out of DeepSeek are actually creating real competition, and that it's just beginning. And recently, DeepSeek, back in December, released a new technological breakthrough called MHC, which demonstrates another efficiency in being able to train models. And it's supposed to be rumored to be inside of their new upcoming DeepSeek R2 model. So essentially, the U.S. is focused on the size of the box to build the AI, while China is focused on the speed of the brain. So the AI race is no longer determined on who has the best data. It's focused on who will win at the transformer level by being able to power these improvements moving forward.
Well, speaking of power, though, I do wonder about who will win when it comes to actually just simply being able to generate as much electricity as going to be needed. We talk often here, X, about the Chinese in terms of how much they're putting online right now when it comes to gigawatts versus what we're doing here in the U.S. Is that a concern to those who worry that China could ultimately move ahead of us?
Absolutely. I mean, in order to scale the infrastructure within the United States that's necessary to both train these models and to allow users to interact with them requires massive scale, which is why we're seeing data centers pop up left and right. However, those data centers require massive amounts of power, and the United States power grid is outdated. Over 70% of our power grid is not ready for this type of technological strain on it. It's ending up where in certain communities, it's increasing the prices of electricity for everyday Americans. America is hitting a power wall while China is out here scaling solar across the entire country. And so again, the AI race is going to be about who has the best quality power to be able to actually allow this scale to happen and to ensure that the right infrastructure is in place to both make the scale happen and sustain it over time.
X, would you argue that China's scaling of solar is their most powerful lever at the moment?
I believe that China has multiple different ways that they're exploring more sustainable energy techniques that are going to put them in a competitive advantage when it comes to power. However, last year, President Trump canceled billions of dollars in NIH grants that were focused on researching new energy techniques outside of nuclear, as well as grants that were being provided through the Department of Transportation to improve our electricity infrastructure across the country. So that's resulted in these AI companies that are standing up these data centers to resort to techniques that are questionable. In some data centers that Elon Musk has set up inside of Memphis, they're using methane gas turbines to power their data centers, which is quite literally putting formaldehyde in the air and affecting the residents who live nearby. So I think that the U.S. has to refocus our attention on ensuring that we focus on multiple avenues of energy to be able to ensure that our grid is updated quickly to catch up to China's progress and ensure that we can take the lead in that race. If they're able to build and scale data centers quicker and faster than we are, their AI models will improve at an exponential pace faster than ours.
Well, if you weren't already worried about that, if you read Dario Amodei's from Anthropic's letter, you're worried about humanity. I mean, he has been sort of singularly negative, I think, when it comes to warning about the societal implications of AI. He's also said that he expects a 10 to 20% increase in unemployment. How do you guys view this? I mean, at the same time, this is a company that is trying to sell their product of AI to enterprise. So it's an interesting juxtaposition there.
Yes, 100%. I mean, Dario Amodei's letter really warns us about 5 things. The first is artificial intelligence accessing rogue autonomy. We know that artificial intelligence is at some point going to become as smart as or potentially surpass human intelligence. And when it reaches that point, it could bypass the human intent or instructions or use deception in order to reach its own goals. Anthropic's own research has uncovered this. And so this first warning is not necessarily to pin down that this is going to happen, but to raise alarm that we as a collective society need to be thinking about this, because the risks of these models are no longer bugs in research labs. There are clear motives that these machines have that we need to mitigate for. The second thing he warns us about is biological terrorism. These models lower the barrier for different people, especially bad actors, to design and deploy deadly pathogens. It puts biological weapons inside of computers and the hands of everyday people. And so we need to consider how we're going to release constraints to ensure that doesn't happen. The third thing that he warns us about is dictators gaining superpowers, where autocratic regimes might use AI for absolute surveillance or for psychological control in order to prevent democracies and difference of ideas and opinions from existing. The fourth thing that he warns us about is economic whiplash, which is a belief that half of these entry-level jobs could vanish in the next few years. The last is the unknown unknowns, which is the fact that there are things we won't know until we get there. And so he's arguing that this technology, which is going into its adulthood, has adolescent level constraints that we collectively need to address and adopt before these threats arrive.
Yeah, good rundown from you there. We covered a lot of it this morning. Of course, the question is whether and what we can actually do. That is a subject for another day, though, X. Thank you for joining us.
Thank you for having me.
When we come back this morning, the CEO of food giant Sysco is with us, SYSCO, on the heels of a guidance raise and earnings this morning. He joins us when Money Movers begins in a moment.
Good Tuesday morning again. Welcome to Money Movers. I'm Sarah Eisen with Carl Quintanilla live from Post 9 of the New York Stock Exchange. Today, health insurance stocks tumbling as the Trump administration proposes keeping Medicare Advantage rates flat next year.
Plus, OpenAI's Sam Altman says the company's planning to dramatically slow down its pace of hiring. What that shift might signal about the AI industry's growth at all costs playbook.
And food distributor Sysco lifting its profit forecast as it sees consumers continuing to spend despite the macro backdrop. We'll break down the quarter and its latest read on food inflation with the chairman and CEO.
Meantime, split markets today. UNH taking the wind out of the Dow, down about 360 here, but S&P adding 35. We are 15 points away from S&P 7K. VIX is cooling off, yields a little bit sticky, but overall, some reversals of some moves we've seen in things like nat gas and silver. Interesting. What an amazing couple of days of market action.
Yeah, information technology is back on top, thanks in part to Corning, which is in that group, which is up 17.5% on this deal with Meta. But a lot of the semiconductors are working again. Intel's back up another 4%. Let's start with the move, though, in health insurers. Like Carl said, UNH dragging on the Dow after some soft revenue guidance, but the sector as a whole moving on plans surrounding 2027 Medicare payments. Annika Constantino joins us with more. So this came as a big surprise, Annika.
That's right, Sarah. So, shares of these health insurers such as UNH and some of these other names like Humana have been under pressure since yesterday afternoon when the Trump administration to keep payments to Medicare Advantage plans, which are these privately run Medicare plans, basically flat. And so CMS proposed increasing these payments by 0.09%. And that's far below the 4 to 6% increase the analysts were hoping for the payment year of 2027. And so what are these rates? Basically, they determine how much the government pays these privately run Medicare plans or these insurers to run those plans. And it can determine how much, these insurers can charge in premiums and benefits. And so that's why we're seeing names like UNH and Humana, who have the biggest sort of presence in the Medicare Advantage market, down today. And so UNH is also getting a double whammy here today with that softer guidance of $439 billion for 2026. That's a 2% decline year over year from 2025. It's also far less than the $454 billion that analysts were expecting for the 2026 year. And so when I talked to the CFO, he did say that this, reflects a lot of the right sizing that this company is doing. So that includes divestitures of its operations in South America and the UK. But it also partly reflects the membership declines that they're expecting in the 2026 calendar year as well. So it's not a great year or not a great start to the year for these insurers.
No question about it. Dr. Oz saying, who runs CMS, it's good for consumers. So how big of an earnings hit do the analysts expect as a result of this policy decision? And are the stocks a buy? Are they overreacting? What are you hearing?
Right, so it's unclear yet, and it's too early to say what this kind of hit is going to have on these insurers yet, because this proposal, it gets finalized in April. So there is a possibility that, there could be a bigger increase than what we saw yesterday. So it's unclear yet, and when I have talked to the CEO of United Health Group and other insurers, they have declined to kind of provide any kind of forecast yet on what that's going to look like for 2027.
Annika, appreciate that. Huge story this morning, definitely moving the indices. We'll talk in a bit. Let's turn to Washington and the latest on the president's trade battle, and now saying he's going to raise tariffs on South Korean imports despite a deal there. Eamon Javers in D.C. with the latest. Morning, Eamon.
Yeah, good morning, Carl. The threat from President Trump came late yesterday in a social media post. The president saying online South Korea's legislature is not living up to its deal with the United States. President Lee and I reached a great deal for both countries on July 30th, 2025, and we reaffirmed these terms while I was in Korea on October 29th, 2025. Why hasn't the Korean legislature approved it? Because the Korean legislature hasn't enacted our historic trade agreement, which is their prerogative. I am hereby increasing South Korean tariffs on autos, lumber, pharma, and all other reciprocal tariffs from 15% to 25%. Now, the impasse comes after a year in which President Trump threatened 25% tariffs on South Korea, then negotiated them down to 15% in direct bilateral negotiations, and held a state visit in which he was given a replica of an ancient golden crown that had been excavated from a royal Korean tomb. But the deal required the South Korean parliament to ratify the terms, which hasn't happened yet. Now, there's an incentive here for South Korea to stall the authority that President Trump used to impose tariffs in the first place, and for his new retaliation threat is under review over at the Supreme Court, and it could be struck down at any point. Meanwhile, President Trump is seeing other traditional American allies distance themselves from the U.S. economic sphere as a result of the trade war and President Trump's effort to seize Greenland. Canadian Prime Minister Mark Carney visited Beijing and signed a trade agreement with China, and the EU yesterday signed a trade deal lowering mutual tariffs with India. And guys, we're seeing even over at the UK an effort to reach out to China and strike some kind of a trade deal there as well. So a lot of moving parts.
Yeah, big piece in the Journal about allies turning their gaze to China. Starmer over there, the Finnish Prime Minister, and then this India-EU deal, Eamon, in the wake of an India-UK deal. So some argue that Modi is definitely sensing a vacuum and is trying to fill it.
Yeah, and there's this ironic moment here, Carl, with the Supreme Court decision hanging in the balance. If the president wants to retaliate, any kind of adverse ruling from the Supreme Court could really hamstring him in terms of retaliation. He would have other tariff authorities, but a lot of those authorities require a much lengthier process to go through rather than sort of the unilateral immediate tariffs that the president's been doing under IEEPA over the past year. So the president might have this instinct to retaliate quickly, but if the Supreme Court rules against him, he might not be able to do it as quickly as he'd like.
Okay, a lot of moving pieces there, Eamon. Thank you. Let's turn to the broader market as we count down to tomorrow's Fed decision. Consumer confidence today coming in at the lowest level since 2014. Joining us now is PNC Asset Management Chief Investment Strategist Youngwoo Ma. Youngwoo, is the market just sort of more numb to these tariff announcements and increases? I mean, South Korea is not an insignificant trade partner, and there was a time where we go from 15 to 25%, and the market wouldn't like that.
Hi, Sarah. Thanks. It's great to be here. I think what the market's really focused on is the interaction between the growth that we're seeing and the upgraded forecasts from economists, which typically lag. So we actually expect those growth forecasts to be persistent going forward, and that what we're seeing now in terms of the beginnings of accelerated growth is probably going to continue throughout the year. So I don't know that the market is numb to some of these disruptions, but I do think that the focus is squarely on the momentum that we're seeing in the economy and in companies right now.
Right, and that momentum looks good to you. You think we can handle if the Fed, we get the Fed tomorrow, they're not expected to do anything and maybe not promise more cuts?
Yeah, I think people recognize, the market recognizes now that the Fed is probably on hold for this foreseeable future. It could be several months until the Fed is really back on track to cutting rates again, and the market is okay with that, as long as those longer term interest rates actually stay well behaved, which they've been recently after a brief scare the other week. So I think that's what's in focus now. The market is not going to be as sensitive to the Fed pronouncements or discussion, and right now the market's going to be more sensitive to growth, to spending, to consumer spending, to capital expenditures, and that's what the market, in earnings of course, and that's what the market is going to key off of.
I do wonder about some of these policy risks, though. Today it's healthcare and these insurance companies, which are down double digits on the new CMS proposal. I don't know, a few weeks ago it was the credit card companies, the bank companies. Before that it was, the Blackstones on the real estate proposal. Things are surprising Wall Street, not in the most pro-business way this year.
Yeah, there have been some surprises. Those risks have tended so far, at least, to dissipate rather quickly. So we'll see how this plays out. We don't know. I think there is a lot of uncertainty surrounding this. Those risks, however, tend to be relatively targeted. To the extent that they exist, they are within certain industries or subsectors. It's not economy-wide risk. And I think that's the important thing for investors, to make sure you stay diversified. There are certain risks that could emerge and certainly will emerge as the year progresses. But we see a lot more opportunity this year than we see risk. So we want to lean into the big themes. We want to lean into AI. We want to lean into technology. We want to lean into some of that emerging market growth that was being talked about before, because it's not just the US. There are trade deals that are being struck across the globe, and there's strong growth across the globe as well. So we think investors really want to expand their horizons a bit when they're thinking about diversification.
Yeah, you look at some of the inflows into international emerging markets at the expense of U.S. large cap. That's definitely the dollar. I mean, it's all over the place, Youngwoo. I do want to ask you about earnings beats and sales beats underperforming by some measures the worst in history. What do you think that's about?
Well, I think we came into the quarter with relatively high expectations, not sky high expectations, but expectations were relatively high. And sometimes this can happen. You can get a quarter where in the moment of earnings announcements, you get pretty muted, or in this case, very muted reactions, even when you get an earnings and revenue beat. That could be the case. That could continue for the next couple of weeks. We think that there's a possibility for some of these mega cap tech earnings to turn that narrative around if it looks like the growth is sustainable and that the spending is relatively well contained. Of course, we know there's going to be a lot of capital expenditures taking place by the hyperscalers, but at least if that looks sustainable, fundable from a combination of cash flows and sustainable debt, I think some of that narrative can turn around. But the reality is there tends to be a little bit too much focus on earnings in the moment. Really what matters is that trajectory as we project out not just 1, but 2, 3 quarters. And we think the driver of productivity is extremely strong this year and is going to sustain that earnings growth.
Right. Today notwithstanding, you look at small caps, look at some meme names, look at high yield. Some argue it kind of combines into what is characterizing as a low quality rally. Do you think that's fair?
I don't know that that's fair. I really don't like that characterization of high quality, low quality. It almost sounds as if only the high quality or what's regarded on certain stock screens as high quality names should be the ones that can perform well or succeed in the economy. Look, you got to look at what is priced in at any given time. And there can be stocks that might not screen well on some of the quality measures, but that given the trends that we're seeing, they might be able to capitalize on those trends well in terms of increasing productivity, increasing profits, and that delta, that change can be greater than for some of the companies that are considered high quality. So I don't like that characterization. I think, look, if the market's rallying, it's telling you something, and I think there is sustainable growth that underpins it.
Okay, Young-Yu Ma, thank you very much for joining us. PNC Asset Management Investment Strategist. I would also note, Carl, that the dollar's down another 0.75% today. Strong yen on those intervention talks. You know, market seems to be okay with it for now, but sometimes these sharp currency moves can be destabilizing.
Yes, euro dollar almost 120. Time to book a UK vacation as well.
I know. It's getting cheaper to go abroad.
Gotta go back 5 years to see some of these comparisons on the dollar.
Mm-hmm.
Still to come this morning, some big earnings movers to get to, including Boeing, which saw sales jump more than 50%. GM earnings, top estimates. We'll get into what that company announced regarding the dividend and buybacks.
And then the New York Stock Exchange owner, Intercontinental Exchange, launching a new tool for investors, tracking Reddit signals and sentiment and turning that data into actionable information. We'll get to that when Money Movers comes right back.
Welcome back. Boeing and GM out with earnings this morning. Our Phil LeBeau talked to both CEOs today and joins us with more. Phil, they made you an honorary anchor on Squawk. You were so busy.
It was a busy morning. Let's start first off with Boeing, Carl. When you look at Boeing, the fourth quarter was a mixed one. It was a loss once you strip out the sale of the Jeppesen Digital Services unit. But that's not really what people were focused on. A couple of things. One, there was another KC-46 tanker charge. We've seen a slew of these over the last several years. Yet another one for about $500 million in the fourth quarter. But they did report positive free cash flow. That's 2 quarters in a row with positive free cash flow. And the production increases that they have been forecasting, those are coming. Here's CEO Kelly Ortberg.
We moved from 38 a month to 42 a month here in the last part of 2025 on 737 MAX. We will move to 47 a month. That's our next increment here in 2026. And then on 787, we started last year at 5 a month, moved to 7. We finished the year at 8 per month. And on that program, we're also moving to 10 per month in 2026.
2 notes from the analyst call, which is currently going on. One reason why you see shares moving higher, the company did flag a potential issue with the engine of the 777-9, which is going through certification, but they still believe that that aircraft will be certified and that deliveries will start next year, also forecasting $1 to $3 billion in free cash flow for 2026. Again, 2 reasons why, or at least that last one is a reason why shares of Boeing moving higher. As for General Motors, what a day. The company reported better than expected earnings for the fourth quarter, but it's the guidance that has shares moving higher. Adjusted profit, $13 to $15 billion in 2026 with free cash flow of $9 to $11 billion, adjusted EPS of between $11 and $13. Any way you look at it, according to CEO Mary Barra, GM is in the right spot right now in terms of its production of vehicles.
Last year, we sold over 700,000 vehicles in this country with a starting price of under $30,000. When you look at the Chevrolet Equinox, the Chevrolet Trax, the Buick Envista, and several other models. So I think we have affordable vehicles, we have premium vehicles, and we have true luxury vehicles and super trucks. We have a wide portfolio, so we can meet the customer where we are, and we truly have vehicles that don't break the household budget.
2 other reasons why shares of General Motors up almost 10% today. The company is raising its dividend by 20%, up to 18 cents a share, and it's buying back another $6 billion in stock. Carl, they're not far. Carl and Sarah, they're not far from $90 a share, something I think very few people expected earlier in 2025.
Just a quick question. That guidance does incorporate the tariff impact that they're still feeling, which makes it even more impressive. But I do wonder if they have to change it if now we have a scenario where the South Korea tariffs go from 15 to 25, because they manufacture there, don't they?
They do. And we asked Mary Barra about that this morning on Squawk Box. I think the approach that they're taking and what she basically said was, look, we're reshoring as much as possible. Who knows how these tariffs are going to shake out? I mean, she didn't come out and say it may not stick, but she did say, look, there's going to be adjustments in the tariff policy and in USMCA. Our job is to mitigate that impact as much as possible. It'll be a little bit lower in 26 than in 25. And again, more reshoring. That's been the answer for General Motors.
Got it. Phil, thank you. Phil LeBeau on GM's big day. When we come back, tremors in the private credit market starting to return. BlackRock at the center of it. We'll explain next.
And the CEO of food giant Sysco is with us, raising guidance to the high end of the range, noting that product cost inflation jumps just under 3% year on year. We just got an all-time high on the S&P at 69.88. This is the first one since January 12th, and the Nasdaq's up a full percent. Stay with us.
Welcome back. New developments in the private credit market once again have some investors on edge. Our Leslie Picker has that story in today's edition of Inside Alts. Leslie, what's the problem?
Yeah, Sarah, that's right. For today's Inside Alts, we're taking a closer look at the business development company space that's known as BDCs. These liquid vehicles provide capital to small and mid-sized companies, a cohort that's come under some pressure recently, leading to some high-profile write-downs. So among those was the late Friday filing by BlackRock TCP Capital, which disclosed an estimate that its net asset value declined 19% quarter over quarter, and that it would be partially waiving the fourth quarter's management fee. TCPC shares slumping 13% yesterday, trading about 28% below its already pressured NAV, although of course rebounding a little bit today. And from a macro standpoint, BDCs are expected to face a challenging year if rates are cut further, because that impacts the amount they can charge for loans and strain their dividend coverage as a result of that. However, Glenn Schorr of Evercore ISI writing this morning that, quote, TCPC's write-downs appear isolated and do not, in our view, signal a full-blown credit cycle in the near term, particularly given the economy's solid footing. Now, he goes on to say that, quote, loss rates are likely to rise from historically low levels, and headline risk around private credit remains elevated, particularly as some loans made in the 2020-2021 range are likely to have issues related to a combination of higher rates, lower multiples, tariffs, and AI disruption. The question, though, is whether the challenges are isolated to a few of these BDCs, many of the BDCs, or just private credit more broadly. And you can actually see the concern play out because it's been weighing on the private credit-focused alternatives over the last few days. Now, for more coverage, subscribe to our Inside Alts newsletter using the QR code on your screen, guys.
I was going to say last few days, or you could argue last few months, Leslie. I wonder what you make of the market's ability to price this in sort of early, and whether how you characterize the risk at the moment.
Yeah, I think it's a really good point, Carl, because you did see those alternative managers underperform the S&P last year. Everyone was hopeful that they would be able to outperform at the start of this year, but you can see the headline risk here is real. It's a sector that's been untested in a real cycle, in a real recession. So there's a lot of jitters just surrounding the space. So every time you see one of these headlines, like we saw with the BDC from BlackRock late last week and kind of the fallout early this week, it really sends ripple effects through the entire market, not just BDCs, but also private credit more broadly. So that reputational risk element is really real here, and therefore you tend to see more knee-jerk reactions when things like this pop up.
But the way the cockroaches last year, I mean, was the upshot of that it was issuer-specific problems?
Yeah, no, exactly. So the cockroach comment, the one made by Jamie Dimon on the firm's conference call as it pertains to private credit and potential incidents, and when you see one, you kind of see more. At the time, it felt like there were just a couple instances of fraud, and that it was isolated at one point in time. But as we've seen kind of at the start of the year, there are some more normalizations of some of these borrowers, which is to be expected given how long rates have been where they are, that you'll start to see some issues pop up. Those tend to kind of be exposed to multiple different private credit managers at a time, and so those ripple effects play out. Now, we haven't seen a huge tick up in loss rates at this point in time, but people are expecting us to do so just as things start to normalize because they've been so historically low. Even if the economy remains strong, you can expect to see some more of these.
Yeah, we'll see whether the market decides this is no longer anachronistic. Leslie, pretty fascinating. Thank you, Leslie Pickard, this morning. Let's get a news update as well with our Contessa Brewer. Hey, Contessa.
Carl, Army veteran and former National Security Council staffer Alexander Vindman is launching a bid today for U.S. Senate in Florida, running as a Democrat. Now, Vindman was a key witness against President Trump in his first impeachment trial, and the candidate showed clips of his testimony as part of his campaign launch video. ICE agents reportedly will have a security role at next month's Winter Olympics in Milan, according to the Associated Press. The federal agents will support diplomatic security details, but they won't run any immigration operations. Sources tell the AP several federal agencies provided security for diplomats in previous Olympics, including ICE's investigative arm, which is called Homeland Security Operations. And Meta plans to test premium subscriptions for Instagram, Facebook, and WhatsApp. The news was first reported by TechCrunch. The subscriptions will give paid users access to more AI features and control over how they share and connect. This may include creating unlimited audience lists and the ability to see users who don't follow you back, which I don't really get, because don't we get that now? I follow people who don't follow me back. Like Lady Gaga, for instance, won't follow me, Sarah.
But you follow her. I get it.
She should.
She will follow you eventually.
Maybe you get more information on them. Thank you, Contessa Brewer. When we come back, Michael Burry just announcing he's buying shares of GameStop. 5 years. Has it really been 5 years after retail traders first upended this market? How those retail traders are still influencing stocks next. Welcome back. It has been 5 years since retail traders upended the market with the GameStop frenzy. Remember that? And this week, the stock on the move again as Michael Burry says he is buying shares. Kate Rooney with us now has more on how retail traders have had a pretty lasting impact here on the markets. Kate.
Yeah, Sarah, that's right. So GameStop, we all remember that, it really became synonymous with stock market gambling at the time and so-called dumb money. There was a lot of negative attention at the time on retail investors. Consensus was that retail would retreat after COVID and after GameStop. That was not the case, though. So this group has been more active than ever and a much more important force we're seeing in the market. So last year, JP Morgan found that retail flows were 17% higher than the peak in 2021 around that meme trading frenzy. On average, retail participation in U.S. equities is now near 20% of daily volume. That's up from low single digits before COVID. That's according to BlackRock. And then Robinhood Steve Quirk telling me on higher volume days, it's closer to 40% of volume.
Young people are very savvy. They're really, really savvy. And my argument to them has been they bailed out the market during COVID and they bailed it out again during the tariffs. Like they were aggressive buyers.
So 90% of Robinhood's 2.5 million clients that joined during January 2021, he says, are still on the platform. They have this outsized appetite we've seen to buy dips. They have been concentrated. Mag 7 names, Palantir, NVIDIA, which did help them outperform at least last year. Vanda Research this week noting a record move into silver as well. They talk about having more turnover than NVIDIA. Institutions now are also paying much closer attention to this group, especially hedge funds rethinking some of those short selling strategies after GameStop. Tom Lee, who I spoke to, says his clients are really watching social media and sentiment called retail difference makers at this point. And he underlined a massive wealth transfer. 76% of household wealth is held by people over 60. He estimates $120 trillion is going to be inherited in the next 2 decades. And guys, we are seeing brokerage firms really trying to adapt and cater to this younger generation of active traders moving towards 24/7 trading. You've got prediction markets booming and private markets. Back to you.
Kate, perfect segue to our next segment. Thank you, Kate Rooney. Intercontinental Exchange today launching a new service called Reddit Signals and Sentiment. The new tool transforms millions of Reddit conversations into market signals for investors to use. The service available on ICE's data platforms. And joining us exclusively today on the launch, Intercontinental Exchange President of Fixed Income and Data Services, Chris Edmonds. Chris, appreciate this very much. Good to see you.
Good to see you. Thanks for having me.
It sounds fascinating. I mean, there's so much intelligence, or at least arguably insight, that's in there, and you got to harness it somehow. How long has this been in the works?
It's been a few months. The biggest thing is in a world where everything is moving at a greater frequency and a higher velocity, you don't know which one of those you're going to get caught in at any moment in time. So being able to process the level of data and the sheer volume of data into something that's usable has really been a challenge facing the industry. So for us, by applying both AI and our data science capabilities and having access to Reddit's massive, very deep conversations going on across their platform is really what led to this innovation here and what we're proud to put out into the market today.
Can you give some examples of tools or triggers that you can pull and what you get in return?
It'll be a lot of user-defined. We don't determine trading strategies at the end of the day. What we want to do is empower them. So if you have a trading strategy on your desk every day, you're using our data in order to make decisions of when to engage or to not engage, depending on what the subject may be. We're giving you that raw, ingestible format that you can take in there, and that way you're not guessing whether or not you got the right last headline, but you're actually able to see that signal and the sentiment along the way. I'll give you one example. We started seeing stuff about the Japanese yen before Christmas in the data. As soon as the snap election happened was announced on January 19th, we saw the signal become a sentiment and immediately go negative along the way. You're going to be able to see that entire trend as you use the service on a go-forward basis.
Who is the you? Like who are you selling this to? Is this for institutional investors?
It is for institutional capital markets. That'll be the primary. That's who ingest our data today in all forms of fashions along the way. It'll be open to everyone, but it's primarily catered to someone who has a very sophisticated platform and program of transactions that they're attempting to manage the risk on, and they want to put that in one more one more confirmation bias in their trading strategy.
I wonder if it feeds the view that, the institutional investor is going to sort of take advantage of the little guy, right, by being now a few steps ahead of them and try to bet against them.
I would say it's probably more of a democratization, Sarah, on that, because now we want to be able to see that. It's so widespread, the amount of data that people are looking at different times. So you and I may see the same data, we may see it at a different time, but for very different reasons along the way. I actually think it brings more investors together around the same level of information to express the view that is most important to their portfolio.
From a tech standpoint, Chris, is this hard to do? Is this a challenge? And are there innovations that's going to let you do even more in the next 5 years?
It is a challenge. I think managing data across the board has been a challenge because there's so much more of that. My earlier comment about, both frequency and velocity, there's so much moving around at the time. What do you do to capture the right information at the right time? Certainly AI has been helpful to us as data science has become a bigger part of the trading community along the way. It has been for years. People were buying satellite images of Walmart parking lots and things of that nature. This is sort of the next evolution in that. The more that we can get that efficient and the more users begin to incorporate this into their trading strategies, they will get better at asking us, how do we provide that next level of data to them? So I do believe the deployment will get easier over the next 5 years. Right now, we're excited about being able to put this out there and be able to and give people the ability to digest it.
Is Reddit still as active as it was, say, 5 years ago during the height of the GameStop?
Not only is it very active, but the depth of it is giving you so much more of the sentiment value of the conversations that are going on across that. But it is a growing platform of messages, hundreds of millions of those happening on a weekly basis that are particular to given opportunities. I'll throw out one other example.
Yeah, we want the opportunities.
One other example might be in muni bonds. Imagine all the things that we're seeing happening today in the world of climate hazard risk and things of that nature and impacting local municipal bonds' ability to raise funds. You're actually getting on the ground feedback now through Reddit communities of how that information you can use that to make your decision of whether or not that is something that's investable for you in your portfolio.
Yeah. I mean, the sell side always talks about channel checks, but we're in a much different world now, especially if you're able to just harness these things that grew organically. Chris, it's incredible. It just started up out of nothing, and it's just a matter of building the bridge from here to there.
100% correct, Carl. And it's exciting for us to bring that because every time we have a conversation about this new capability, the next set of questions is giving us another way to go back and look at how do we package that for the consumer to use along the way. And it gives us a lot of hope for the future of how we can democratize the information and make sure people are best informed when it comes time to make a trading decision.
Fascinating. Chris Edmonds, please come back and maybe talk about progress the farther it gets rolled out. Good
Appreciate
to see you.
Having me and look forward to it.
Up next, the CEO of food distributor Sysco is back with us on results. Just raising adjusted earnings guidance to the high end of the range. We're going to get his read on what he's seeing in terms of food inflation and consumer growth and much more. We'll be right back. Welcome back. Take a look at shares of Cisco. This is the food distributor climbing this morning after reporting a beat on the top and bottom lines in its fiscal Q2 and issuing some pretty bullish guidance for the year ahead. With U.S. food service volumes up year over year, despite what we've seen in the food business and the restaurant business, a deceleration in foot traffic. Joining us now in a CNBC exclusive is Cisco CEO Kevin Hourican. Kevin, it's great to have you back. So where is the growth coming from? What sort of categories and channels, and where do you see it most?
Good morning, Sarah. Thank you for having us back on your show. Let's start with the end up macro consumer. As you just described, foot traffic to restaurants was down year over year and quarter over quarter sequentially. But importantly, Cisco grew our business during that same period of time. Revenue up 3%, adjusted earnings per share up 6.5%. Better than what we had modeled and expected. It's coming from two main businesses. Our core U.S. business saw an improvement of 140 basis points of volume through our business. And notably, our international division posted a 25% increase in operating income. That's the 9th consecutive quarter of double-digit profit growth from our international division. The how and the why it's happening is we're improving our execution. Our sales colleague population is increasing their productivity, and we're winning share from the overall marketplace.
Yeah, what the analysts call the self-help or Cisco-specific story. You know, just for people to get a sense of your scale, 337 distribution centers in over 10 countries, serving 730,000 customer locations. So you're in a good spot to be able to answer, Kevin, what is happening overall with food inflation?
Yeah, let's start with just the headline first. We describe the cost of food inflation as the inbound cost to Cisco, and that number was plus 1.4% in our Q2, which was down sequentially versus the prior quarter. For end consumers, for Americans, that's actually a good thing. It means food affordability. So we're leaning into this affordability opportunity. There are select categories that are driving the reduction in inflation. So examples, poultry is down year over year, dairy is down year over year, and produce is down year over year. The first two are actually due to anomalies. A year ago at this time, there was a very significant avian flu influenza that was causing challenges in that marketplace. So it's great to see the food cost in poultry, in produce, and dairy down year over year. Beef is still very inflationary. High single digits. There just simply are not enough cattle head being ranched in the core U.S. domestic market, and demand for beef continues to grow, whether or not that's GLP-1s increasing the need for proteins or just Americans' consumer appetite for protein. So beef costs up year over year across all 13 Cisco attribute groups, inflation of plus 1.4, which is a deceleration, and that's good for end consumers.
Kevin, would you argue that attempts to increase imports of beef have helped at the margin?
Yeah, beef, as I said, Carl, is up, in the high single digits. Food is mostly from within country in each country. I like to start with stats. So 95% of food in every country around the world that Cisco operates within is sourced from within that country, mostly just because of the supply chains and the cost of getting product fresh from the rancher to the end consumer table. We are, Cisco, working on increasing sources of supply, finding additional sources of supply, not specific to beef, but example only in seafood, increasing the number of countries that we source from, Carl, so we can reduce inbound costs to Cisco, so we can share in those savings on with end consumers.
What about the new food pyramid that the administration unveiled under Health and Human Services Secretary RFK Jr., calling for more whole foods, meat and dairy, and calling for a reduction in processed foods and sugary meals, something, we've known but haven't really seen that officially happen at the government level. Is it changing anything for you, Kevin?
Let me just say, net is a very good thing for Cisco that the pyramid is inverted. We are in the fresh food business, so fresh proteins, fresh produce. We actually have the largest fresh produce business in the country through a banner we call FreshPoint. We also operate the largest fresh protein business through a banner called Buckhead Newport. So increasing purchase of fresh foods, increasing purchase of protein, those are good things for Cisco. That is a tailwind to our sector for the longer term. Leaning in with our restaurant operators to help them bring those food trends forward. I'm sure on TV you're seeing commercials for protein bowls. Our sales reps, we have 6,000 plus sales reps who are foodie pros, are introducing those concepts to mom and pop restaurants all across the country, all across the world. And it is a good thing for our business. We also think it's a good thing for the health. Eating fewer processed foods, eating more fresh local foods is good for the health of consumers, and it's good for Sysco's P&L as well.
You may not want to weigh in on something as politically loaded as immigration, but I do wonder whether or not immigration flows into this country are adding to labor shortages that increase wages and hence increase the cost of food.
Yeah, Carl, it's a very loaded question, but I'll just start with, we deserve a safe and secure border and over time, an increase in legal immigration into our country. And the why is our supplier community and our customer community. Think about the agricultural fields. Think about the meat plants that I was talking about earlier. Those are many times immigrants that are working, legal immigrants that are working in those settings. Think about the dairy industry. Then think about your end restaurant, mom and pop. Who's washing the dishes in those restaurants? Oftentimes legal immigrants. It's important to our supplier community and to our customer community over time to have appropriate levels of legal immigration. And also we need a secure and safe border. So we're interested in this topic. We're meaningfully supportive of improvement on that topic. And I think we need to be patient on that topic.
Okay, Kevin, thank you for coming on, weighing in on some of the hot issues touching your business. We appreciate it.
I appreciate you having us
Harkin.
on today, Sarah, Carl. Have a great day. Thank you for having Cisco on.
We do have some news this morning on a developing story in social media, and for that we'll turn to Julia Boorstin. Morning, Julia.
That's right, Carl. The social media trial is set to start today, and we have just learned that TikTok has settled with the defendant for this trial. They've reached an agreement in principle to settle this case. Now, TikTok does remain a defendant in other trials and other personal injury cases that are set to happen here in California and others around the country, but they have settled for today in this trial. Now, the trial will proceed because YouTube and Meta are still scheduled to go to trial today. They have not settled. We saw Snap settle last week, but the trial will proceed with the plaintiff filing suit against Meta and YouTube for creating addictive algorithms and so things like autoplay that make Meta's platforms and YouTube's platforms addictive, and also accusing those platforms of failing to disclose that in their communication, especially to parents. So we're going to be heading into this shortly. The jury selection starts in about 10 minutes. Back over to you.
Wow. Between that and some of these proposed age restrictions, a busy morning in social media. Thank you very much, Julia Boorstin. When we come back, a slowdown in hiring at OpenAI. What that signals about Silicon Valley's strategy and thinking about the notion of growth at all costs. When we're back in a couple of minutes. Got more layoffs across tech today as Pinterest plans to lay off 15% of its staff, and Amazon's 14,000 cuts are expected to come any day now. CEO of OpenAI, Sam Altman, reportedly told his staff of plans to dramatically slow down hiring. Deirdre Bosa is looking at all of this in today's Tech Check. Morning, Dee.
Hey, good morning, Carl. So the OpenAI piece, that stands out because it signals something bigger about where the AI race is heading. Last year, hiring fast was a sign of growth and winning in AI, but OpenAI is now flipping that logic. So CEO Sam Altman, in that Business Insider report, he warned employees that aggressive hiring can actually be a signal of poor planning and a setup for layoffs once AI starts doing more of the work. Now, that doesn't mean that the AI talent wars are over. In fact, our own Ashley Kaput heard from a source that OpenAI still expects to nearly double its headcount this year. But the key here is that it's planning to be deliberate so that it can avoid the kind of layoffs happening now at places like Pinterest and Amazon. It's also a rare show of discipline from a company that has been under constant pressure to scale, pointing to a broader shift that investors, they should be watching very closely as big tech earnings gets underway. The next phase of AI, it's not about pure expansion. It's about leveraging what you already have. So, for example, if CapEx continues to climb, investors should maybe ask how targeted the build-out is. They should scrutinize utilization rates at those data centers and look for productivity metrics like revenue or free cash flow per employee rather than raw headcount or just raw spending. So in other words, who's getting the most out of what they have already spent or workforces that they've maybe already cut and added to in certain places. So Anthropic CEO Dario Amodei, his essay that was published yesterday, it's getting a lot of attention for its warnings about how disruptive AI could be, but strip away that sort of doomsday framing, and there is a more practical point underneath, and that is as AI systems mature, the constraint shifts from building faster to managing and deploying what already exists. Now, that framework, it lines up with what OpenAI is signaling here about hiring, and one that investors should pay close attention to during big tech earnings. So it's about leverage and efficiency, maybe not raw numbers and headcount.
Yeah, I mean, it also raises the question, Deirdre, of how many people it actually takes to build out AI. I mean, it's not like building out other industries. Yeah.
Right. And we've just seen like huge leaps in efficiency on not just the model side, but the productivity side. This year feels like a real moment where we're finally getting agents that can do something. So maybe, too, this is a signal they're seeing that within their own workforce and saying, let's slow down a little bit because we know that AI is doing more of the work, and that's backed up by what you see Amazon and Pinterest doing.
Yeah, we've talked about it for so long in financial services and software. It does feel like it's really starting to hit the road. Dee, thanks. Appreciate that very much. Deirdre Bosa. We don't talk about the Fed too much, but we'll see what we get tomorrow.
And maybe if they get a question on how AI is influencing the labor market, they continue to get it, and they're kind of like, we're watching it.
Yeah. Coming just off of these intraday highs, let's get to the judge.
Carl, thanks so much. Welcome to the Halftime Report. I'm Scott Wapner, front and center this hour. 72 hours to decide this rally as mega cap earnings, the Fed decision, and potential government shutdown hang over this market. We'll discuss and debate with the investment committee. And joining me for the hour today, Joe Terranova, Stephanie Link, Shannon Saccocia, and Jason Snipe. We will go to the markets. The Dow is red, as you see. Everything else, though, is green, led by the NASDAQ as we get ever closer to those mega cap earnings that will begin tomorrow. The S&P hitting a fresh all-time high today. Gold and especially silver are reversing. Silver was down 5% earlier. We should note that every day because the moves there have been just astounding. And it is down near 7%. You have another tariff threat from the president. You have the Fed decision tomorrow. You've got Microsoft, Meta, and Tesla tomorrow as well. Apple on Thursday. And then the possibility of that shutdown coming on Friday. What's on your mind as you watch these markets today?
Well, there goes the broadening narrative. The S&P equal weight is actually down on the day. So we're back to the environment in which it's the mega caps, it's semiconductors, it's Lam Research, it's KLA Corp, it's Applied Materials making new 52-week highs. It is Apple making a nice recovery, Microsoft making a nice recovery. So once again, it's all about tech. And you're right, this is a critical week. And over the next 10 days, we're not just going to hear this week, but we're also going to hear next week from Alphabet and from Amazon. And the key is the spending. The spending is the key. And the spending has never really been the question. What really is the question is when the return.
Overspending.
No. It's when does the return on spending actually happen? If you think about it, the operating cash flow for Amazon, they spend 90% of that operating cash flow on building out data centers in AWS. The return on that spending, that's really the question as you begin to look forward. We're going to hear from all of these companies over the next 10 days about it.
What's interesting, Steph, is that many of these names are running into the prints, which does something to the bar. Maybe it raises it. I'm not sure, because the stocks hadn't performed all that well going into the numbers. However, if you look at the 1 week performance from many of these, Meta is up 11% over 1 week. You own that. NVIDIA's up 6.5%. Apple's up 5%. This is one of the few periods, really recently, where you can look over any kind of short period of time and say, wow, they're all up, because they haven't been trading all together as a monolith. But they have, over the last week, trying to potentially anticipate what I think the street thinks is going to be a good reporting from these companies.
I think the reports are all going to be good, but to your point on the performance of these stocks, yes, they've had a good week or two, but they are all, except Google, they are all down from their highs. Meta is still down 15% from its highs. Microsoft down 12%, Apple down 10%. I actually like the setup of that, when they're down, and yet they are starting to see a recovery. I do think that Joe is right about the spend. I think the spend is going higher, but to me, the most important thing is free cash flow after the spend. And all of these companies are going to still have considerable free cash flow. So Meta is going to have $16 billion this year. Amazon is going to have $41 billion in free cash flow this year. Microsoft at $77 billion, et cetera, et cetera. So they're all going to still have free cash flow and flexibility to continue to invest as they should, given the AI revolution. As a whole, earnings are running at about 9% so far.
They are. That's ahead of expectations.
And that is ahead. And I actually think you're on track to do something like 12, 13%. There are some aggressive targets, Scott, out there of 16, 17%. I'm not there. I'm in 12, 13 in a 3.5%, 4% GDP world. And it's not just revenues. It's not just earnings. It's not just revenues. It's also margins, which I pay very close attention to.
Yeah.
And I think the economic data still is very supportive of all of this. And so you want to pick your spots. I don't think it's just going to be Mag 7 that take over. I think I can name a whole bunch of companies that reported in the past week that are down because earnings is stupid season.
No, I'm glad you raised that point, because I was literally going to go there next.
Yeah.
That Wolf points out today what they call punishing price action to start earnings season. That even very solid results, these are their words, the share prices of companies beating on the top and the bottom lines have witnessed negative relative price action after reporting. They do not think it's sustainable, though. They expect double beats to exhibit positive price action as more companies report. It is interesting, though, to see good reports not being greeted well on Wall Street, and that leads to maybe some trepidation heading into these numbers over the next couple of days.
Well, there's the potential that this is just a sort of re-rating in terms of valuation that investors are looking at. But I would agree with Wolf in that paradigm cannot persist. In our view. And so we have 81% of companies that have beat on earnings so far for the S&P 500. That's a pretty darn good number. And I think what you're doing is you're looking at these earnings releases that are likely to come in the next few days. And Scott, there's really no reason that, given the broad strength, there's no reason for the Mag 7 to upset that trend. I mean, there's absolutely no reason that they cannot continue to grow their earnings in this type of environment. I think more importantly, though, Scott, there's some of these exogenous weights on the market right now. There's some concern about a potential shutdown. There's concern about what's happening with the Fed and will they continue to be accommodative. And one could say that as we get further into earnings season, you're going to see companies in, for instance, in consumer. I actually think that's going to be really important from an inflection point perspective. The consumer confidence data today was pretty weak. And so I would say if we can get through earnings for tech and then we have consumer on the horizon, I actually think that that's where you could start to see some of this double beat really start to catalyze a stronger move, to Joe's point earlier, in the broadening direction.
I'll just come back to you for a moment when you say, the question is not about the mega cap companies growing their earnings. It's not about that at all. It's about the growth rate.
Right.
People aren't worried about them growing their earnings. It's, can you still grow your earnings at 50% or whatever that you had been to justify the appreciation of the stock and the multiple in these names. That is what investors are grappling with as they look at the breakdown of the market, the broadening of it. Questions about, well, can tech still lead the way if those growth rates are slowing in any way whatsoever?
That's what we've been talking about, those valuations potentially being vulnerable for 6 or 7 quarters now, Scott, and yet we continue to see the growth. And I think to Stephanie's point, if you look at the narrative from these hyperscalers in particular, they are still willing to put forth the spending. They are still willing to meet what they think is still an undersupply, to Joe's point earlier, of this infrastructure. And so therefore, there's no reason to think that without any evidence of a dissipation of demand, which we don't see for AI, there's no reason to think that they can't continue to grow them. Most importantly, though, however, that delta is compressing. We're seeing the rest of the market grow their earnings, and therefore that delta compressing, I think, is going to be representative of that broader
I got a developing story I'm going to get to in just a second, because it's interesting, and I know you're going to want to hear about it, but I want to hear from you first.
Yeah.
As we said, the stack this week is the earnings, the Fed decision. I'm not expected to do anything is the Fed, but you know, the questions to Chair Powell in the conference, the news conference, are going to be interesting, not only on Fed direction, but Fed investigation. So, you know, that's going to be hanging over the market a little bit.
Sure.
We're looking towards Friday. Are we going to get another government shutdown? Market's sort of yawning a bit at that.
Yep.
What's on your top of your mind?
Yeah, no, I think all those pieces loom large, but I think for me it's definitely mega cap tech, right? We're hearing from Apple, Meta, Microsoft, and Tesla this week. I think to Joe's point, CapEx is a very important piece for me. I mean, $400 billion of spend in 2025, $500 billion plus planned on spending in 2026, and north of $600 in 2027. I think the return on this CapEx is going to be critical. Free cash flow, again, what Steph mentioned, I think is important as well. Margin expansion. What does that story look like? We need to see these companies continue to grow. I think the other concern for me a little bit last year was the debt market, right? From Meta, Amazon, the rest, you know, Oracle as well, and starting to dip into the debt market to raise funds to continue to build and the innovation that we're seeing. So I think that's what's really on my mind. We'll see from many of these names. I think Amazon will be solid. I think Microsoft hasn't traded well. It'll be interesting to see what goes on with Azure, and also I think there's some interesting thoughts playing out in the market in terms of Microsoft having a legacy product, and what does the real integration story look like? I think it's been a story of AI first names really starting to continuing to perform. So I'm really anxious to see what Microsoft reports.
Okay, let's jump to a newsy item. We'll come back to this, I promise you, and we'll also discuss what's been happening with some of these health insurance stocks today, because that's a dramatic move. But this is new at noon. And it is Daniel Loeb's third point, stepping up its activist campaign today against CoStar, as they continue to be unhappy with how that company is operating, especially with its strategy around residential real estate and its investment into Homes.com. So the stock is up 2% today because Loeb's sending a letter today to the board, writing in that letter, quote, "From its inception 5 years ago, the company's plan to build a dominant online classifieds business in the U.S. residential real estate industry was deeply flawed, with structural problems affecting both sides of management's proposed two-sided marketplace." Now, this all comes after Third Point and CoStar had entered into a standstill agreement last April, along with D.E. Shaw, which resulted in the company appointing independent directors to its board. I spoke with Mr. Loeb last hour, who made it clear to me that little has changed since then. And in the letter, he says, quote, "Our dim view is plainly shared by other shareholders, underscored by the abysmal stock performance of the past 5 years, down 27% versus a 94% total return for the S&P 500. Mr. Loeb also writing that the Homes.com investment by CEO Andy Florance was a misallocation of capital, quote, "overseen by a feckless board rewarding him with exorbitant pay packages, like an elementary school child who wins a prize even for finishing last. Mr. Florence's bonuses are perhaps the costliest participation award our firm has witnessed," end quote. So the standstill agreement expired at midnight, and now they will go right to shareholders with their own slate unless something happens by March 13th. Mr. Loeb telling me earlier today, quote, "We've heard from numerous shareholders who see us as doing God's work in keeping this board and management accountable for this misallocation of capital." We, of course, did reach out to CoStar as well, which provided this statement. We intend to continue to engage with our stockholders, including Third Point, to help them better understand our strategic plan, which has already garnered support from many stockholders and analysts. Maybe so, and the stock is up 2% today. But Joe, as you know as well as anybody, because you were in the name,
yes,
and you got into it in the summer, and you told me off camera, not good. This
Awful.
has not been good.
So I share as a shareholder. I support everything that Dan Loeb is saying in this letter. Let's take it from two different perspectives. I'll talk about the position and what happens with it in a second. But just from a fundamental perspective, I don't understand why a company who has for decades profited from the commercial real estate market has made this pivot towards residential real estate through the vehicle being Homes.com. They're trying to almost be Zillow, and they're spending a tremendous amount of money in doing it. Now, it does not mean that Mr. Florence and the board will not ultimately be successful, but the strategy needs a pivot. And I think Dan Loeb here getting involved and pushing them towards some form of a pivot is a good thing. They've made some very good acquisitions in the past. The acquisition, remember Matterport? I think Josh was in that name for a while. There was a $1.6 billion acquisition earlier in the year. That's been a good acquisition. So they have the ability to change course here and go in the right direction. I like what Dan Loeb is doing. I think if you are in the name, you want to stay in the name and see this through. From the perspective of our position, we bought the stock at the end of July. Anyone that has a chart in front of them knows that was a horrible time to buy the stock. On Friday, we will rebalance. On a one-year basis, the stock is down 11%. One-year performance is very critical in our momentum formula. So at the end of Friday, there is a chance that this name is no longer in the portfolio. But that doesn't mean for you, the viewer, if you're listening today, that there can't be a successful pivot on the part of Mr. Florence and the board as it relates to its residential real estate being pushed here by Dan Loeb, because I think it can be.
I mean, Loeb didn't see it necessarily having to get to this point. They tried to reach out prior. The company didn't respond to prior letters, which led to this one, as we said today. And it sounds like you wholly agree where Mr. Loeb says, as he's targeted what he deems as the problems, these are his words, a horrendous return on capital, investors not fooled by management's continued excuses about missed targets, and what Mr. Loeb writes are desperate attempts by management to buy more time, and that shareholders clearly see through that. It sounds like you do.
And everything is centered on Homes.com and its ability to compete with Zillow. And there has not been a successful navigation right now of that strategy. That's clear. Is spending a tremendous amount of capital, is spending it probably in the wrong direction. And if you think about it for a second, is residential real estate so strong right now? Is there that degree of traffic that we need? Do we feel confident about where residential real estate ultimately is going to go over the next 18 months, unless the administration gets very active in trying to stimulate the increase in traffic and in activity? I think residential real estate is in a transactional recession. So why focus specifically on building out a business that right now is frozen?
All right, we'll follow the story and see what transpires next, and you'll obviously let us know in terms of your rebalance, if anything happens there. I just want to get that news out, but let's go back to the conversation that we're having about all these mega cap tech stocks and these earnings reports that are looming large, because you do have some calls on the street today that I want to bring to your attention, because as I said, these names have been running, and they've been running for about the last week or so into these prints. So Meta has a deal with Corning for up to $6 billion for fiber optic cables. They're going to test premium subscriptions. Meta is on Instagram, Facebook, and WhatsApp. So I know Steph already spoke about Meta. Where are your hopes lying as we head into a quarter that, you talked about, well, it's going to be all about the spending's not going to be a problem. Last quarter, the issue was spending. The fact that there's too much of it, according to investors.
The spending, I said, is not ever going to be the question. The spending's not the question. It's the return on the spending that's the question. Spending's a problem when we're spending it from places that we're questioning, to Steph's point, where the free cash flow is not present. So just present rather. So just ask Oracle about that. By the way, Meta, $6 billion worth of spending through 2030 with Corning. I think people have fallen asleep, myself included, on Corning, ticker symbol GLW. Stock is up a lot today. Any pullback, 95, 100, that area, I will buy the stock. I think you want to buy the stock. And I think it really validates the fact that companies like Corning, like Cisco, are now participating in this AI infrastructure build out. The fiber optics that are needed are so incredibly important and so integral. Other mega cap players now are probably going to step forward. And understand, Corning's business is really well diversified. When you think about their premium glass for consumer products, we've known about that for several years. So Corning today exceeded its September of 2000 all-time intraday high. It pierced above it somewhere around 113.5. I think the stock goes much higher. There's a lot of excitement, up 16% today. Let it settle in, and I think there's a name you could buy.
Just back to Meta. Meta's going to post probably 20% earnings growth, 26% total revenue growth. They are going to see metrics that are going to show ROI on AI in that time spent. It's going to be time spent. And time spent is going to go higher. There's no question about it. Now, the biggest question is, what is the guide for OPEX and CAPEX? And OPEX, $150 billion is the expectation. And for CAPEX, it's $115 billion. If it's any higher than that, stock's going to have problems.
Is the ad revenue going to continue to be the cash cow to fund it all?
Of course. Absolutely.
Okay.
Doesn't matter, though. I mean, it's not like the street doesn't know where that's coming from. The ad market can continue to be strong. There's obviously, to Steph's point, is an uneasiness with a company, quite frankly, that has had, according to investors and the investment community, a spending problem before.
Yeah,
they have.
There's a little bit of lack of trust surrounding management's ability to spend properly.
And that's why the stock is, and that's why the stock is down 15%.
Well, right. That's why you see on the far left side of your screen what happened after earnings. What about Amazon? Target gets lowered today at B of A to 286. Jason, you own that name. Stifel says you want to own it into the print. I guess, okay, the stock's woken up too, like everything else. It's up 4.5% in a week. But last year, it did next to nothing.
Did nothing
Now,
last
what
year.
now?
Yeah, so I like Amazon, and even coming into last year, Amazon was a favorite of mine. You know, the retail business op margins have continued to grow and accelerate. I think what's exciting for me about Amazon is AWS is also re-accelerating. We're expecting 20% year-over-year growth there. You know, I think that it's going to be an interesting play thinking about the consumer, right? We're talking about government shutdown potentially. I think the government shutdown the end of last year was hurtful to a lot of these kind of retail adjacent e-commerce type of names, but I do think Amazon has some tailwinds above them, in particular on what we continue to experience with AWS through this year.
All right, so let's finish this block of the show with the other big news item, and that's the Fed meeting. It's underway, obviously. The decision coming tomorrow. Senior economics correspondent Steve Leisman will be headed to D.C., and he will be in the room asking questions. You did your CNBC Fed survey, which is interesting. The average outlook is only for 2 more cuts this entire year and no cuts in 2027, no matter who the new Fed chair is.
I continue to be confused by that, Scott. There is, look, the market is looking for a rate cut, as is the survey, come June when the new Fed chair is put in. But right now, despite the expected arrival of a new Trump-appointed Fed chair in the coming months, the survey is showing we're only forecasting modest changes to the funds rate over the next 2 years. So take a look. 2 rate cuts priced in. Here's the Fed expectations. 0 expected in 2027. That would bring the funds rate down to 3.13 on average, according to the survey. And it really comes, Scott, with a boost in the outlook for the economy. 23% say 23% is the recession probability over the next 12 months. That's down from 30%. There is a contingent, though, that does want to cut at this meeting of 31%. And it's that improved growth outlook, Scott, that could explain why there's only limited rate cuts ahead this year and next. Take a look at what's happened in the forecast. GDP this year, now 2.4%. That's up a bit from where we were in September, for example. CPI getting down close. Remember, you adjust that down 0.5 point to kind of come up with a PC. And the unemployment rate, 4.5%, little change. So Scott, Richard Bernstein, CEO of Richard Bernstein Advisors, writes in, economists should admit the economy is cooking and cutting rates is quite imprudent. We'll leave it there.
I mean, it's so interesting that, obviously, I think you probably would suggest Powell thinks that the Fed is in a great spot, right? They've managed their way through this, mistakes along the way, et cetera, and here we are, and growth is going to be better than expected, and inflation, though sticky, is coming down. So he thinks they're in a great spot while absorbing all of this criticism and the broadsides from the White House that they're so off course and misguided in where interest rates should be. What a unique period.
Well, let's put it into some context, Scott. The president wants the funds rate brought down to 1%. Let's assume the Fed achieves its 2% inflation target. 1% minus 2% is minus 1%, which is to say the president wants a recession-type stimulative funds rate, a negative real funds rate. And I don't know anybody who's calling for that. I mean, if you go to 2, you're at 0 real. And if you're at 3, you're at 1 real. And that's kind of where most people think the Fed ought to end up. And the key here, Scott, is it doesn't look or feel to anybody like an economy in the need of that kind of emergency stimulus.
Let me lastly ask you, because as I said, you're going to be in the room and you'll ask a question as you always do. In the past, the chair has refused really to entertain any questions regarding what the president thinks about either him or policy. But then, of course, you had the announcement of the investigation and the unprecedented response that we saw from the chair himself via video. I'm wondering how you think that's going to impact what the chair's willing to say tomorrow when he undoubtedly is going to be asked more than one time about this relationship with the president and the investigation itself, how that's going to impact what's actually said tomorrow.
I mean, you raise a great point, Scott. He had held back, and now at least some part of the dam is open. I don't think he's going to get away by saying, I'm not going to talk about that. That's outside of my lane. He's talked about that for quite a bit. And now there are some questions to answer. And the question is, how does he answer and respond to that? My guess is he will keep to the investigation, which is the one thing he's talked about. And that, of course, he attended the Supreme Court hearing of Lisa Cook. And whether or not he's willing to talk more specifically about the challenge to the Fed's independence presented by the president. And also, by the way, coming appointments. I mean, I'm wondering, Scott, if he's now ready to talk about, is he planning to stay or go when it comes to his term as governor? That had been a dead-end question, but at some point, maybe he's going to tell us if he's going to stay and why. He may or may not.
Yeah, new levels of intrigue, no doubt about that, at a meeting where we're not really expecting any intrigue at all regarding the actual move itself in rates. We'll be looking for you tomorrow, Steve. Thanks.
Right. Thanks, guys.
That's Steve Leisman. We'll see him down in D.C., of course, tomorrow. Up next, we have a bunch of committee stocks on the move today following earnings. We have our top calls of the day as well, and we're back in just 2 minutes. Got to talk some UNH. I mentioned at the top of the program some of the health insurance names. This one's down almost 20%. Despite the earnings beat, they give a soft revenue guide, but the Trump administration is proposing keeping Medicare Advantage rates flat next year. Humana's having its worst day since 2009. It was down 24%. But look at that. You, Steph, have a comment here? You own United Health.
I think it's a buying opportunity after you actually let it settle for a couple of days. I think this is the first proposal from CMS. In 2 or 3 months, we'll probably get a revision. It's not going to be the 5% that people expected. It's going to be a lot less that the industry gets in terms of overall funding from the government. It'll be about $700, $800 million versus billions that they were expecting. But something's got to give, Scott. Something's got to give. I mean, you can't have
something
flat
is giving.
pricing. You can't
Something
have,
definitely is giving.
You can't have flat pricing. You know what's going to happen?
If that ain't giving, I don't know what giving is.
You know what they're going to? You know what? The seniors are going to lose. Okay, people on Medicare are going to lose because every one of them are going to cut back. And for United, it's only about 13% of their book. They have a very diversified book. And I thought, Jason, I thought of you this morning that what a shame.
Yeah, you own it too.
Yes, you do. I thought, what a shame. They finally are showing progress on the turnaround that we have been waiting. And they gave guidance, actually, for the full year of $17.75, which was way better than I thought. I thought you were going to see like $12 or $13. So you're talking about a stock that is the leader in the industry with a very diversified book and pricing power and a great management team. So I understand the stress of today. I do. And numbers might have to come down. But I think before they come down, I actually think they're going to start scaling back on the business.
Can we back this up for a year or two, please? Let's see a 1 year. Jason, what's your comment here?
Yeah, so I mean, obviously, it's not good at all, right? The stock was up 7% last week, right? So there has been some momentum building. I think Hemsley, as a known commodity, will be responsible for this turnaround. And to Steph's point, this is a diversified business. It's not like Humana, right? So I think, you know, not to say that it's an overreaction, and there absolutely will be a revision in April from CMS that I do think will kind of lift the number. And last year, when there was a 5% reimbursement rate, you saw in the midst of all that was going on with UNH, you saw the stock pop. So
I understand, but you guys may correctly suggest that this is an overreaction for a one-day move. But I asked for the 1 year chart for a reason. To show you that the stock's cut in half. And is that whole thing an overreaction?
That's old management. That was a terrible CEO doing a terrible job.
When did the new CEO come in?
I think it was like April. I think it was like April, May. Is that
around the springtime last year?
Okay, well, where's the new CEO?
It takes a long time to reprice. By the way, he bought $12 million the day he started of stock. So that's kind of telling, too. He has a very proven track record. He grew Optum Health when he was the CEO. So he's back. He's got a new CFO. And I think they're being prudent on guidance. But guidance was better than I thought. Margins were better than I thought. Medical loss ratio better than I thought. I mean, that's why I say it's such a shame that this news came out. And it was a shock. It really was. That's why the stock is down. But it's 13% of their book. So to me, Humana is much more at risk in terms of this announcement versus United Healthcare. And you're talking about a stock now trading #1 in the industry, 16 times earnings.
Well, I did say Humana worst day since 2009, and that's when it was down 24%. So, I mean, the day is still young, I suppose. But we'll see.
But in the last
gesticulating over there like you wanted to make a comment.
Well, we've had these names in the portfolio in the past, so I know them well. I guess you could look towards Elevance or Centene, which we've owned in the past, which is less dependent on Medicare. But Steph, I'm not questioning at all your position, and I think you're probably right. But when you say that prices have to go higher, if you think about the last 2 years of President Biden's administration, those were negative years, and these companies were able to thrive in that environment. So I think the shock is that the expected figure was 5%, and it's going to come in flat to down. And guess what? It's a midterm election year. So it's going to be flat or down.
Absolutely. I mean, the Trump administration was supposed to be their friend, right? This industry's friend. And obviously they're not. It's a shock. It really is a big surprise. But I'm telling you, you're going to see a lot of exits in this business if you can't make money on this business, and you're not going to be able to at flat pricing.
What kind of time frame do you have in your mind that you say if this is a buying opportunity, new CEO's gotten no credit? When do I need to come back to you and say, okay, what's up now? In 3 months?
Yeah.
that fair?
I think
We look
that's
at it in
fair.
3 months and see what's happened?
Yeah, I'm trying to be a
6?
little bit longer term in
6?
terms of, because I think this is #1 company on sale. They'll get through it. By the way,
That's a serious question, too. I mean,
that's
I'm
fine, that's
curious.
fine.
Like,
But guess
I
what?
really
You know
want to
what?
know
They
that.
also reiterated today they reiterated their medium to long-term earnings growth of 13 to 16%. They didn't have to do that today, and they did in the face of this news. So
Well,
we're
maybe
gonna
they're
get
just trying
through
to, like,
this.
hey, we got a little something to hang your hat on.
No, that's not this management team. Come on,
I
that's
don't know.
silly.
I don't know.
No.
I don't know the
Come back to me in
motivations.
3 months.
I don't
You
know the
can see.
motivations of a CEO who sees their stock doing what it is doing today.
Well, he's feeling it too.
All right. Let's get the headlines with Contessa Brewer. Hi, Contessa.
Hey there, Scott. Family members are suing the U.S. government over the killing of 2 Trinidadian men in a military boat strike. The government said they were smuggling drugs. Families accuse the government of wrongful death and extrajudicial killings. It's the first lawsuit stemming from the Trump administration's military campaign in the Caribbean and the Eastern Pacific. According to the Defense Department, 125 people have died in that campaign since September. The Pentagon is not commenting. President Trump met with Homeland Security Secretary Kristi Noem and her top aide, Corey Lewandowski, last night for almost 2 hours. The White House official confirmed that meeting to MS Now, saying it centered on Minneapolis and how strategically to move forward following the killing of an ICU nurse by federal agents on Saturday. Border Patrol Chief Greg Bovino is expected to leave Minneapolis today as the president reshuffles the immigration operation there. And D.C. Delegate Eleanor Holmes Norton confirmed she's retiring at the end of her current term. She has held that non-voting role since 1991 and served 18 terms as the sole representative of the nation's capital. You know what they love to say in D.C., Scott? Taxation without representation. They're the only ones.
This is true. Contessa, thanks. Contessa Brewer. Up next, Mike Santoli. He joins us with his midday word next. back. Mike Santoli joins us now for his midday word. I mean, I can't imagine it's much different from what it's been the past couple of days because we're still waiting for the stuff we've talked about we're waiting for.
That's right. And it's also day 3, really, of the kind of migration back toward the top of the index, the mega caps. You know, my longstanding position, you can have a broad market or you can have the S&P 500 attack new records. It's hard to get both at once, and you're kind of seeing that today. So it is light volume today. It seems like there's a lot of sort of placeholder buying in the stuff that's been beaten down, the high quality stuff like Apple and Microsoft. Meantime, I have to give the market credit for sidestepping a lot of these potential volatility events that are ripping through the currency markets. Obviously, silver down 7% today. So also, for that matter, what you guys were just talking about in the health insurance. So far, market is rotating away from those hazards, and it's staying intact. But yes, waiting for whatever the Fed's going to tell us in terms of guidance. I think the market's also done a good job of staying supported when the market-based expectations for rate cuts has been diminished. We're not expecting even 2 cuts this year at this point. So we'll see. Also, absorbing a bad consumer confidence number today as well.
All right. I'll see you in a little bit on Closing Bell. I look forward to our conversation. That's Mike Santoli. Coming up, Meme Mania turns 5. Our Kate Rooney following the money on how retail investors have become a force that Wall Street can no longer ignore. Welcome back. Been 5 years since meme mania swept Wall Street, cementing retail's role in this market. Our Kate Rooney is following that money for us. 5 years and counting.
I know. know, Scott. It feels like yesterday. So GameStop at the time really did bring some negative attention to retail investors. The incident became synonymous with stock market gambling and so-called dumb money. And consensus, if you remember, was really that retail would retreat after that frenzy. Not the case. We have seen the opposite in the past 5 years. This group is more active than ever and a much more important force in the markets at this point. Last year, JP Morgan found that retail flows were 17% higher, even than the peak we saw in 2021 around all of that meme trading. Retail participation in U.S. equities is near, on average, 20% at this point of daily volume. It's up from low single digits before COVID. That's according to BlackRock. And then Robinhood's Steve Quirk telling me volume on higher days, it tends to be closer to 40% of retail participation. He also says that 90% of Robinhood's 2.5 million clients that joined just in that month of January 2021 are still on the platform. They stuck around and they've had this outsized appetite to buy into dips. They've been concentrated in some of the Mag 7 names, Palantir and NVIDIA, which did help them outperform at least last year. Vanda Research this week noting a record move into commodities. You got silver, which has seen more turnover than NVIDIA this week. Institutions are paying closer attention too, especially hedge funds really rethinking some of the short selling after GameStop. Tom Lee, who I spoke to, says his clients are really watching social media and sentiment called retail difference makers at this point. He did underline a massive impending wealth transfer too. 76% of household wealth, he said, is held by people over the age of 60. He estimates $120 trillion will be inherited over the next 2 decades. You've also seen brokerage firms really trying to adapt and cater to this younger generation of traders. 24/7 trading, predictions markets, for example, are booming. Also more private market offerings, Scott.
All right. Kate, thank you very much for that look. That's Kate Rooney. I mean, you know, to Kate's point at the beginning of this whole meme thing, it's like from ridiculed to resolute and right. Retail's been right on this rally for most of it and resolute to stay with it when others maybe had wavered. Now, there were periods of time, obviously, within the last handful of years when there's been turbulence that maybe retail had ran for the exits, but man, they've been right.
This is a profession that if you choose it, you have to understand that it is constantly teaching you, and you have to be willing to accept the learning process. And I think that's what's happened. I think it's a wonderful thing, this evolution, the learning curve that we've seen. We have right now a younger generation who is far more financially literate than I was when I was at their age. We also have the introduction, and hat tip Brad Gerster on this, of these Trump accounts, which is going to fund accounts for children until they're 18 years old. So their eyes are going to be on the market. That's a good thing. Financial literacy is really good. And I think we're at a place right now where we should welcome it, we should applaud it, and we shouldn't say anymore, oh, institutions, smart money, retail's dumb money. No, that's not the case anymore. I think we've balanced that out.
I think you can bury that at this point.
The accessibility of information, too, is also empowered the retail community.
We should be encouraging, not discouraging, as advisors in my seat. The next gen is incredibly interested and engaged in the market. That's actually a positive, Scott, because it gives us a better, stronger investor to help them build their wealth over time.
All right, we'll do the setup after this break. Let's do the setup beyond mega cap earnings. IBM tomorrow after the bell. After the bell, Stephanie Link.
So the only thing that worries me about IBM is I wonder if the software Red Hat number comes in as expected. It has been running soft. I think you're going to see a reacceleration for 2026, but I worry a little bit. And the stock is not cheap at 26 times forward estimates. I still like it very much. I still like the CEO. It is up a lot. It's had a really good couple of years. So I like it. I just think the expectations are quite high, and I just worry a little bit about that software piece.
Okay. Lam Research is after the bell as well tomorrow. Joe T.
Mentioned it at the top of the show at an all-time high. This is a company where you're going to see most likely the 7th consecutive quarter of revenue beat. Look for China to be strong. The foundry business is remarkably strong. EPS somewhere around $1.17, probably about $5.2 billion in revenue.
Talk about a chart leading into a print. Wow. Yep. Raymond James, Joe T, that's also you after the bell tomorrow.
It's engagement, and that's why this stock, I think this stock's up about 5% so far year to date, but it's engagement in the trading community. It's the reason that we own CME, NASDAQ, Interactive Brokers, and Charles Schwab.
All right, ServiceNow, Jason Snipe, that is tomorrow, and it is after the bell as well.
Yeah,
busy tomorrow.
No doubt about it. So ServiceNow is obviously got caught up in the software slide. Didn't have a great year last year, down 13% year to date. So I think for me, RPO is going to be very important. I think 21% RPO growth is expected, around 27% subscription revenue growth expected. Fourth quarter is typically their strongest quarter. I think a concern for me is the potential headwind is shorter government contracts. So I'll look to see what happens there.
LVS tomorrow after the bell, Stephanie Link.
I think Singapore is going to continue to hum. I think China, though, obviously it's a bigger part of their EBITDA, almost 70%. That has to recover. I think you are starting to see a recovery. We're seeing it from other companies like Estee Lauder, like Starbucks. So I think the consumer in China is recovering, and I expect a solid number.
Okay, we will take a break. We'll come back on the other side with final trades. All right, we're back and excited to announce today our next CNBC Pro live event, Wealth for Women, on May 28th at the NASDAQ market site in New York City. It is all about financial strategies for women who are investing for themselves and for others, featuring some of our top female CNBC contributors, including Stephanie Link and Shannon Saccocia. For more, scan the QR code on your screen or visit cnbcevents.com/wealth4women. Please do it. We'll do finals next.
Are you following the Halftime Report podcast? What are you waiting for? Look for us in your favorite podcasting app. Follow the Halftime Podcast now.
All right, he is back. Jeffrey Gundlach will join me once again tomorrow because it is Fed Decision Day, and it's the first one of 2026. So we look forward to catching up with Mr. Gundlach after Jay Powell, the chair, finishes his news conference. And of course, we can digest what happened in that meeting and what was said. Today at 3 o'clock, we'll lead you into the rest of this big week, of course, with Chris Harvey, Anastasia Amoroso, Kevin Gordon, and the former Dallas Fed President, Richard Fisher. So we're looking forward to all of that. Let's do final trades, though, before we leave you on this day. Jason Snipe.
I like Sky Rizzi. Actually, AbbVie. I'm sorry, I love Sky Rizzi and Rinvoq. $31 billion
those commercials.
Expected. Yeah. Hey, look, those numbers look good to me. I like AbbVie. Stay long.
All right. Shannon, top that.
The commercials are very catchy. Actually, you go healthcare. I think we talked a little bit about, managed care here, but the affordability challenge is real. And so whether it's drug price overhang or reimbursement rate overhang, there is going to be something the government's going to do about attempting to make healthcare more affordable. And I don't think that's just going to hurt insurers.
All right, Stephanie Link.
SLB, I like oil services. They beat on revenues, earnings, EBITDA, raised guidance. They're buying back over $4 billion of stock and dividends and all that.
Okay, Joe.
Amphenol.
All right, good stuff. I will see you on the closing bell in a couple hours. The exchange is now.
Thank you very much, Scott. The S&P hits a new record today. Retail money is on the chase and tech is on the rise again for now. Welcome to the exchange. I'm Kelly Evans. And take a look at the NASDAQ, which is leading markets higher today as we await Mag 7 results. It's up almost 1%. The S&P is up 27 points, getting really close to 7K now, about 23 shy of that mark. Very different story in the Dow, though, which is down more than 500 points. United Health alone is shaving more than 400 points off of that. We'll have more on that shortly. And by the way, the small caps are also lower today. But some of the AI names are jumping. Micron is up as it invests to build chips in Singapore. CoreWeave up for a second day on its new infrastructure deal with NVIDIA and an upgrade. Those shares are up 12%. And Corning soaring almost 17% on its deal to supply Meta with fiber optic cables for its data centers. All of that said, let's begin today with some rather dour news on the economic front. Consumer confidence dropping to an 11-year low this morning. The Fed having to weigh that weakness against other stronger economic reports like GDP. Their two-day meeting is today and tomorrow as speculation mounts over who might be next to lead the Fed. Steve Leisman has the latest from the CNBC Fed survey. Hi, Steve.
Hey, Kelly, while the market focuses on the outlook for rates from the Fed, there's an equal concern with the outlook for the Fed's independence to set those rates, especially with a president who continues to push the boundaries of that independence. The CNBC Fed survey finding that compared to Powell, the next Fed chair is expected by 72% of respondents to be slower to respond to inflation and also quicker to respond to unemployment by 67%. That is, they are seen as more dovish than Powell is. On the question of who the next Fed chair will be, we have Warsh at 50%. That is different than its former Fed Governor Warsh. That's different from the prediction markets, which has Reader well near 50%. Reader's down at 14% in our survey, Hassett at 11%. But as to the next Fed chair should be, that is the preference of the respondents, Waller once again topping the list with 44%, Warsh at 25%, and Reader's all the way down at 6%. Reflecting the change in the expectation of Hassett being named chair to Warsh, 56% of respondents now say the next Fed chair will conduct policy independently of the president. That's up from 41% in the prior survey. The control that the president has over the Fed will depend on how many appointees the president has on the Fed Board of Governors. That's linked to whether Fed Chair Jay Powell will stay on as a governor after his term as chair ends. He hasn't said, but 42% of our respondents think he'll stay and 42% think he'll go. So it's a dead heat right there on what Powell will do. Meanwhile, 61% of respondents say their concern about the Fed's independence would increase if the president had a majority of those appointees on the Federal Reserve Board of Governors. Kelly?
We'll come back to this in a moment with Julia, Steve, but what did you make of the consumer sentiment number this morning? And just, again, to kind of set the stage here a little bit, the University of Michigan one has had a lot of bouts, both under Biden and under Trump, of falling to these record lows and leading to less confidence in the survey and so forth. This is the Conference Board. We haven't really talked so much about this one having the same issues. You know, people say, oh, these surveys are all politicized now or what have you. This appears to be a read that has more to do with perceived weakness in the labor market. And at a time when we're all weighing whether the Fed's going to drop that emphasis or not, I have to imagine this leads them to say, we're still concerned about the labor market, and therefore we might end up still doing, one more cut or two.
I think those are excellent questions. I don't know that I have answers to them. I would say that the Fed will look first at how consumers spend and less at how they feel. As you know, Kelly, there's an interesting disparity between those two things often, that people get, report pessimistic numbers or pessimistic attitudes in these surveys, and they go ahead and spend. So that's going to be the key. Our survey suggests that consumer spending should remain relatively strong. As for the reflection of the job market, the data is showing us that it's a low higher environment. Certainly some of the pessimism about the job market could be picking up that low higher. And again, I think the Fed will ultimately follow the data here. What I'm hearing and seeing both in the survey and from Fed officials is that they do not see the labor market falling through the floor here, that there is some expectation of weakness, but not tremendous. In fact, Kelly, the outlook for unemployment in our survey is only 4.5% by the end of this year. and about the same next year. We're at 4.4 now. So at least for the forecasters, there is not an expectation of a serious deterioration in the labor market.
So you would take the consumer confidence number with a grain of salt?
It was one of the front page stories I wrote in the Wall Street Journal in 2000, Kelly, was this notion that, in 2001, in the wake of 9/11, with incredibly depressed consumer sentiment numbers, we sold more cars than ever in our history. Of course, there was an incentive there, leading to the idea that you don't know what people are going to do till you know the price they're going to not do it at. So it's an interesting split. These consumer sentiment numbers can tell us about the outlook for big ticket purchases down the road, if people are really afraid of their jobs, if they're really depressed about the outlook. But ultimately, there can be big differences, and I would follow the spending more than I would the sentiment.
I'm going to look up that story, Steve, and we need a page tear, I think. I want to see that byline anyway. Steve, thanks very much.
I can send it to you.
Yeah, thank you, Steve Leisman. Let's bring in our next guest now, who expects 1 or 2 rate cuts this year. But going back to the question about the Fed chair, she says she'd remove that expectation for cuts if the Fed Chair Powell and Fed Governor Lisa Cook stay on, regardless of who the president nominates to replace Powell. Let's bring in Julia Coronado. She's the founder of Macro Policy Perspectives. Julia, it's great to see you, and feel free to layer in your own thoughts about the consumer confidence number on top of all of this.
Yeah, absolutely. So the Conference Board is extremely valuable for exactly what you pointed out, assessments of labor market conditions. We've got a long history. It's got a pretty reliable track record mapping into actual labor market data. So while I agree with Steve, the confidence doesn't map into spending so much, but the assessments of the labor market do tell us that we're still in this not just low hire, low fire, but slow bleed. We've seen the unemployment rate drift higher over last year. The consumers are telling us that demand for workers is still lower than the supply of workers. And so it's consistent with slowing wage growth and an upward drift in the unemployment rate. So this notion that we've perfectly stabilized here, maybe, but that may be a premature, and ultimately that's a forecast. It can go either way. And what we're seeing is that labor market conditions are, not great.
So you were expecting a cut or two this year for more or less political reasons under a new Fed chair the president appoints. Now would you expect a cut or two based on what we're seeing in this data?
So this data is sort of consistent with our assessment of labor market conditions, which is that we actually do forecast an upward drift in the unemployment rate, something that will lead to another cut or two as the year unfolds. So that has been our baseline forecast, and I would say what we're seeing in the Conference Board numbers supports that forecast. As far as the sort of political pressure and influence on monetary policy, I think we've gotten some relative good news in the sense that the subpoena and the threat of an indictment seems to have led to somewhat of a backlash in Congress and sort of a resolve on the part of Chair Powell. I think odds that he stays have gone up as a result of this more recent pressure campaign. And that could lead to more protection of the institution, more stability in the FOMC, and a slower rotation in personnel.
Right. All of that said, I just wanted to sort of clarify this. So, because originally you said, look, if Powell and Cook stay on, you might not expect any more rate cuts. But now we have this data, and I'm not trying to make too much of one data point, but if you're saying you expect an upward drift in the unemployment rate, then do you think a cut or two is warranted regardless of personnel?
Yeah, I think if we realize the upward drift in the unemployment rate, a cut or two is justified. Ultimately, again, depending on what's happening with inflation, but assuming that we get at least stability to some potential downward drift in the second half of the year, then you could adjust the Fed funds rate lower on the basis of a rising unemployment rate.
Right. So that's not a political influence per se.
No, it's sort of a magnitude. So we kind of agree with the FOMC's tilt. Their baseline forecast is tilted towards a cut. Either none or maybe one or maybe two, depending on how you expect the data to play out. That seems to us like a fair assessment of where we are in terms of their dual mandates. But again, the idea of adding in a cut or two is that you've got a new chair, potentially, leaning more in that direction in a committee that's willing to be somewhat deferential to that.
Prior to this morning, I would say most of the data points had people recalculating the stickiness of inflation. Yeah. Is 3% the new 2%? Are we okay with that? GDP is back up at 5.5%. Again, Atlanta Fed, we don't know how exactly it'll shake out. So that had kind of been the concern was, hey, we're running it hot, and now we're going to change the Fed chair. Now all of a sudden today makes you sit back and go, well, are we running it hot, or is the labor market, and this is the case a lot of the Doves have been making, that the labor market is weak enough that, we have room to cut a couple more times?
Yeah, I think that the running it hot is mostly a financial conditions assessment, and what we see in the consumer confidence numbers is evidence of the K-shaped economy. So yeah, the average consumer is not doing so great. Wage growth has grinded lower to where it's barely beating inflation, and consumers are feeling that pressure. To Steve's point about auto sales got, they went down quite a bit in the fourth quarter, and automakers are assuming a pretty price-sensitive, budget-conscious consumer in 2026. So yes, the stock market and anything tied to AI is, everything's coming up roses. But, for the average consumer who is depending on their labor income to finance their spending, it's not a disaster. We're not falling off a cliff, but it's not great. Consumers aren't feeling awash in prosperity right now.
All right, Julia, thanks so much. It's going to be an interesting meeting tomorrow. Maybe it'll be a nothing burger, but they again, as always, have to kind of walk this very fine line. Julia, thanks so much. Julia Coronado, Macro Policy Perspectives. Let's turn now to the markets. It feels funny to say the Dow's at session lows on a day when the Nasdaq's up 1%, but that is the case. And the S&P hit a new record high this morning as it's getting closer to 7,000. The Nasdaq, by the way, is still around that October resistance level. On that note, let's bring in Scott Kroner, U.S. equity strategist over at Citi. Scott, Julia, we were talking kind of through the difference here of the impact that the Fed chair announcement is going to have, overlaid with the data and everything else going on. So how are you telling equity investors to think through where rates are going right now and kind of the announcement risk around all of this?
Hey, Kelly. So I'd say there's, the starting point is which rate. So, house view is we get nothing burger tomorrow out of the Fed, as you suggest. We think there's room for another 2 cuts this year, if not 3. The nagging concern is regarding the labor condition, no question about that. But for the focus on Fed funds, you're still looking at a 10-year yield, which hasn't budged versus where the Fed first began easing a while back. So in terms of how you actually resolve this remains to be seen. Obviously, the inflation outlook is part of this. I would say from my perch, looking at our equity call for this year, we're less concerned about inflation as a function of this labor condition and the influence and read-through to aggregate consumption levels. And we're also looking at the AI playbook longer term is probably having as much of a disinflation component to it as anything.
Maybe we can show the dollar, and for what it's worth, Rick Santelli said the 5-year auction just now was a little weak. I think he gave it a C-. So are you concerned about the weakening dollar, some of the parabolic moves we're seeing in the metals, this idea of, choose your word, dollar crash, sell America, all of these kinds of things?
Yeah, we're definitely keeping an eye on this. I wouldn't say concerned yet, but what I would remind is that we've got a fairly aggressive and optimistic view towards the S&P this year. Our 7,700 target assumes that we can hold current valuations about where they are and appreciate courtesy of what we still think is a very confident look towards the earnings growth picture. However, as you begin to watch the 10-year yield hover in this 420 range when we think it ends the year sub 4, when you look at the dollar trajectory and the potential of what that can do in terms of incremental swings to non-U.S. Buying intentions for the U.S., it does weigh into how we think about that valuation picture. Not an issue yet, but certainly something that we're monitoring as we go through the Q4 reporting period.
So just to be clear, and because not many people are expecting the 10-year to go below 4%. Some are. As you said, that's your view. But explain how you think that affects U.S. valuation.
So essentially what happens is that the premise for how we hold 24 times trailing or even look at 22, 23 times forward is that lots of things have to happen into the way we think about a fair value assumption for the S&P. We do our own work on this, but what I would say is going into this year, 6 weeks ago when we're putting out our forecast, embedded in that, holding this current fair value paradigm had been a fairly stable, if not gradually improving dollar, along with this downward trajectory in 10-year yields. So again, we're a month into the year. It's very premature to say a major change in our view, but what we're identifying here are some areas of concern that we're going to have to monitor, I'd say, in the weeks, months ahead.
I see. And look, it could be like last year where the dollar index hit 110 and then went on a straight path down, right? So who knows? Quick final question. What do you think of Mag 7 earnings? You worried about them?
Not worried about them. Now, there again, we're very aggressive in terms of our full year earnings picture for the S&P. We've already been modeling into our 320 estimate, Kelly, a scenario where the Mag 7, we're now onto the Elite 8, as a reminder, continues to give us a beat and raise, but about half the magnitude of last year's. So we're assuming that we're going to get a fairly steady drumbeat of good news on that. What I would point out, though, is that as we look at the broader index, this Elite 8, Mag 7 construct versus everything else is still actually more expensive versus its own history than the Elite 8 are. So essentially what's happened, to your earlier point on this part of the market kind of trending sideways, is that it's actually right now set up to have the more attractive relative valuation opportunity as a function of where PEG ratios, PE to growth ratios are. So we think that there's still opportunity here on the long side in the AI play, and why we maintain an overweight on tech.
Who's the eighth?
That's Broadcom. Its weight has now surpassed a couple of the other Mag 7 constituents.
Broadcom. Look, it deserves a spot at the table. We're going to have to keep expanding it at this rate. Good problem to have. Scott, thanks so much. Really appreciate it today.
Thanks, Kelly.
Scott Kroner with Citi. Coming up, not so magnificent. The health insurers are tumbling after the Trump administration has proposed keeping the rates Medicare pays them basically unchanged. That's leading Humana to its worst day since 2009. UNH, by the way, also gave weaker than expected full-year revenue guidance. Those shares are down 20%. We'll look at what to do with the space next. Plus, silver, big reversal yesterday, pulling back from its record high as gold prices aim for their best month in more than 40 years and are slightly higher at this hour. We'll get a technical take on the moves we're seeing in metals and the dollar index near a 3-month low. We're back after this.
This is The Exchange on CNBC.
Welcome back. Shares of United Health are plunging today, nearly 20%, after issuing softer revenue guidance for 2026, despite a modest Q4 beat. But of course, it's yesterday's news that's really dragging on the whole sector, with several of the big healthcare names tumbling after the Trump administration has proposed keeping the Medicare Advantage rates flat for 2027. My next guest says she'd be a buyer of several of these names here, which are selling off today. Let's bring in Jessica Tassin, Senior Research Analyst at Piper Sandler. Jessica, welcome to you. And I thought Stephanie Link put it nicely last hour when she said, look, at some point, these companies are going to get out of the business. So are you buying these stocks because they're going to get out of the Medicare Advantage business or because they're staying in it?
Not at all. So hi, thanks for having me. I would say for United Health specifically, Medicare represents about 2/3 of their premium revenue between Medicare Advantage, D-SNP, standalone Part D, and MedSup. So they're absolutely not getting out of the Medicare business. But I would say last night, CMS published the 2027 Advance Rate Notice for Medicare Advantage. This happens every year around the end of January. CMS proposes rates and finalizes them in April for the subsequent year. This year, in light of what were, accelerating trends across fee-for-service and Medicare Advantage throughout 2025, CMS somehow arrived at a 0.09% expected average change in revenue for 2027. That's down from about 5% in 26, and it's clearly a problem, right? These rates are nowhere near sufficient to cover what are rising cost trends. But I would emphasize that United is not getting out of this business. If anything, given their scale, infrastructure, and resources, they're kind of best equipped to weather the challenging rate environment. This is more just, a risk and ends up being bad for beneficiaries, where Medicare Advantage has proven to provide extremely high consumer satisfaction. It improves outcomes. It democratizes access to care. It aligns incentives, and it lowers costs over time. So these challenging rates are more just a risk to the entire industry and ultimately for beneficiaries, not necessarily for United Health Group, specifically in our view.
I mean, there's so many fascinating things that you talked about there. So why is the rate flat? I mean, I know you're not on the inside of this, but you're saying that it's not enough to cover the cost of delivering this care. Is that right? So what's going to happen? I mean, the shares are down then because what do they expect the knock-on effects of this implementation then to be?
Yeah. So the rate is flat because of a couple of different things. I would say, first and foremost, there's kind of a headline number or an effective growth rate, which is 4.97% according to CMS. Our estimates had put it closer to 6.5%. So already your effective growth rate for 2027 is kind of below expectations. I would say in addition to that, you've got a combined close to 5% headwind from a couple of risk adjustment changes that CMS is proposing to implement in 2027. Right, 5% kind of top line or headline growth rate, less the 500 bips of year over year risk adjustment headwinds gets you to about a flat rate, flat advance notice relative to 2026. In terms of just what that means, right, you have cost trends or utilization plus unit costs that are growing at high single digit, possibly double digit rates year over year in 2026. That's a continuation of an acceleration that we've seen over the course of 2025. And so just as rates are flat against that accelerating trend, you get just kind of a widening spread between what you're paid and what ultimately you have to reimburse as a payer.
Yeah, so which is to say, with all the information that you have at your fingertips so nicely, that doesn't sound like a great business to be in.
I would argue that it is a very noble business to be in. We know that 34 million seniors in 2025 chose Medicare Advantage. It's a business that we believe aligns incentives, appropriately reimburses both MAOs and providers for high value care, and it has the best potential, in our view, to improve outcomes, democratize access to care for all beneficiaries. And so I would say our view, and I believe United's view, is that this is a noble and correct business to be in. Rates will fluctuate year over year, but I would say United's scale, infrastructure meaning their significant value-based care business, put them in a better position to endure a challenging rate environment than most other MAOs.
Yeah, I appreciate the chivalry. I mean, it's admirable, but is it sustainable? And I guess if the administration is basically saying, we don't want to shell out as much for these, enormous cost centers, then perhaps what's the best case scenario here? That it's just a one-year passing thing?
Yeah, so we have an opportunity in April to see the advance notice rates get revised higher based on more recent experience. So the advance notice is based on claims through 2Q or 3Q of 2025. We have an opportunity for some positive revision in April at the time the final announcement comes out, based on more recent experience, meaning 3Q, 4Q, 2025 claims. So that's your first kind of potential opportunity. If that doesn't occur, we would expect to see that in 2027, MAOs continue to pare back benefits, meaning reduce benefits for beneficiaries and pull out of certain geographies and certain types of plans.
Right.
That will be the second consecutive year of that happening at a kind of industry-wide scale. And I would hope that the message at kind of the federal level is received at that point, right, which is that rates are insufficient to cover cost trend, and we need to reinvest in Medicare Advantage for the sustainability of the program.
We'll see if they are receptive to that message. Certainly the alarms are going off for investors here who have already been through a tough time in the space. Jessica, thanks so much for joining us to break it down today. I appreciate it.
Thanks for having me.
Jessica Tassin with Piper Sandler. Coming up, we're marking 5 years since the start of the GameStop meme stock saga. We're going to look at how retail investors permanently altered the investing landscape during the pandemic and how Wall Street is adapting. That's next.
Discovery Houston, press to ATO. Liftoff of mission 41B, the first flight of the orbit of Discovery, and the shuttle has cleared the tower. 3, 2, 1, 0, 0. Liftoff. Discovery, go and throttle up. Discovery's 4 computers now have primary control of critical vehicle functions.
It's the 5th record intraday high of the year for the S&P, and the Dow's at almost 500 points. Dom Chu is here with a closer look at the day's biggest movers.
Dom, how about we focus on what's happening with the NASDAQ? You mentioned the Dow and the S&P's new record highs, the Dow kind of lagging a bit. But if you take a look at the NASDAQ Composite Index, we are going back, and with this winning streak, pushing back towards the record highs that we saw back in October of last year. If you take a look at this kind of bluish grayish line, the one that's kind of coalescing around this market right now, you'll see that's the 50-day average price for the NASDAQ Composite Index. We're just slightly above there now. Now, this trading range has been in effect pretty much since the record highs. On the high end, you're talking roughly 24,000. 24,019 is the record high. And on the low end, roughly 22,000, just a little bit below that. We're pretty much stuck right in the middle. Emblematic of that kind of push and pull, that kind of coalescing around that 50-day average price on a rolling basis has been some of the themes from a stock-specific perspective here. Just look within technology, computer chips and memory storage. If you take a look at the best performers on a 3-month basis within the NASDAQ, Western Digital, Micron, Seagate, the biggest gainers there, memory, chips, storage, that sort of thing, a big story there. Meanwhile, if you look at some of the biggest laggards within the NASDAQ 100 during that same span, ARM Holdings, Qualcomm, and Broadcom acting as that kind of tug of war plays out there. And maybe even more so emblematic of that, check out the biggest influences on that NASDAQ trade, some of the biggest stocks out there. NVIDIA shares pretty much flat. We're down 1% for the 3-month span there. Alphabet shares are up 25% on the upside. Meanwhile, weighing it down, shares of Meta Platforms down 11%. So that tug of war is playing out just like that. And by the way, Kelly, as we talk about the setup going into the 4 key earnings report this week, Microsoft, Meta Platforms, Tesla, right? All of these trades coming together in Apple. Each of those stocks is down going into their earnings print on a 3-month basis. So we'll see whether or not that's the catalyst for the return to record highs or whether or not this kind of move back towards the lower end of the range continues. Kel, I'll send things back over to you.
Is the bar low enough? We'll find out. Dom, thanks.
You got it.
Shares of GameStop extending yesterday's gains, higher 5% on the week after famed investor and early GameStop buyer Michael Burry said he believes in CEO Ryan Cohen and, quote, likes the setup. This comes on the 5-year anniversary of meme stock mania, when a group of online traders first sent GameStop shares soaring, essentially transforming the investing landscape permanently. Kate Rooney has a closer look. Kate?
Hi, Kelly. So yeah, GameStop at the time really did bring a lot of negative attention to retail investors. The incident was sort of synonymous with stock market gambling, so-called dumb money. Consensus was that retail would retreat after that frenzy, but we have seen the opposite in the past 5 years. This group is more active than ever and a much more important force in the markets. Last year, for example, JP Morgan found retail flows were 17% higher even than that peak mania back in 2021 around all of the meme trading. Retail participation is now near 20% roughly of daily volume. That's up from low single digits before COVID. That's according to BlackRock. And Robinhood's Steve Quirk tells me on higher volume days, that's closer to 40%. And then 90% of Robinhood's 2.5 million clients who joined just in that January 2021 month, they are still on the platform. They stuck around. There has also been this outsized appetite to buy dips. They have been concentrated. Some of the Mag 7 names, Palantir, which helped them outperform at least last year. Vanda Research also noting a record move into silver, which has actually seen, they say, more turnover than NVIDIA this week. Institutions are also paying close attention, especially hedge funds, rethinking short selling after retail investors went after those shorting GameStop. If you remember, Tom Lee, who I also spoke to, says his clients are also watching social media and sentiment really closely. He called retail difference makers and then underlined this massive impending wealth transfer. So 76% of household wealth, he says, is held by people over the age of 60. He's estimating $120 trillion, Kelly, is going to be inherited in the next few decades. Brokerage firms are also starting to adapt, really try to cater to younger traders. You got 24/7 trading and then prediction markets booming. They're all trying to get a slice of that.
As big a force as corporate buybacks in the market. That was Brian Reynolds noting how significant the retail investor flow has been.
That's a great point.
Kate, thanks very much. Kate Rooney.
Thanks, Kelly.
To Contessa Brewer now for the CNBC News Update. Contessa?
Hi there, Kelly. The fatal midair collision in Washington, D.C. that killed 67 people January last year was the result of systemic failures. The National Transportation Safety Board released their findings today after a year-long investigation. And they cited overwhelmed air traffic controllers who relied too heavily on pilots, separating their own aircraft from each other in the crowded airspace. Regulators also blamed the FAA for not acting on recommendations on ways to make the area safer. Nearly 500,000 Americans still don't have electricity or heat after this past weekend's deadly winter storm. Temperatures are still plummeting around the country. PowerOutage.us shows more than 100,000 customers still don't have power in each of 3 states, Tennessee, Mississippi, and Louisiana. The ice has been very thick, and that's a real problem. Yale is going tuition-free for students from households making as much as $200,000 a year. Students from families making less than $100,000 will pay nothing. Tuition at the Ivy League school next year is $72,500. When adding in room and board and other fees, it rises to about $98,000. Hey, they should look at, some elementary schools in Manhattan and compare prices, is all I'm saying.
Yeah, they're getting close, I think. It's crazy. Preschool, anyway, we could go on. Contessa, thanks very much. Contessa Brewer. Coming up is yesterday's reversal, a sign that metal's momentum is starting to fade. Silver's up 50% this month, trying for its best month since 1979. Copper is nearing its first 6-month win streak in 15 years. Do you chase it or fade it? We'll get a technical take on the whole group next.
As America celebrates its 250th anniversary, CNBC spotlights the companies that rose with the nation and continue to shape its future.
I am Lisa Laird Dunn, ninth generation and CEO of Laird & Company, America's oldest distillers. The origins of the company start back to 1698 when my family arrived here from Scotland. They came here for safety, to find a new way of life. Since apples were plentiful right here, they felt that that would be the perfect crop to work with. Laird's Applejack is the original American spirit. My ancestors were Revolutionary War dragoons under the command of General George Washington. So when he was in this area, we did provide the troops with Applejack. We've always remained true to ourselves, to our craft, to our value, to our vision. Our product has not changed. The actual recipe, the process, how we produce our product is still authentic. Currently, we have 3 generations that are working together. I am extremely proud and excited that I could pass my passion on to my 2 children to continue our legacy. I think the largest pivot during the history of Laird & Company would be during Prohibition. Not many companies re-emerged once they had to shut down. My ancestor had the foresight to petition the federal government for a permit. We were allowed to produce 1 million gallons a year of apple brandy for medicinal purposes. Once Prohibition was lifted, we had the inventory. America has a culture that celebrates entrepreneurship and individual success. We embody the American dream, and we've been able to continue that American dream for 300 years.
Precious metals have soared over the past week. Silver up nearly 14%, gold up nearly 7%. But my next guest says yesterday's action in silver has all the signs of a meaningful blow-off. But when it comes to gold, that could be a little more difficult to call the top. Let's bring in Jonathan Krinsky, the chief market technician at BTIG. Jonathan, welcome to you. So it's over for silver. Sell it now.
Well, I mean, the caveat here is that it actually started to go parabolic back in December. At that point, it was about 60% above its 200-day moving average. And if we go the entire history of silver outside of the Hunt Brothers move in around 1980, that's about as wide of a spread as it's ever gone. And of course, here we are yesterday at about almost double that, over 120% above the 200 days. So we are in rare territory, in some ways on par to that Hunt Brothers bubble. But if you look at the action yesterday, you had about over 300 million shares traded in the SLV ETF, all-time record, and on a notional or dollar volume basis, traded about $35 billion worth, which is almost the same as the S&P 500 ETF, the SPY, which you almost never see that. And so, that type of frantic action combined with the intraday reversal does certainly put us on watch for some meaningful correction over the coming weeks and months.
What about the rest of the metals? Because I often hear this argument that, oh, well, take a look at so-and-so, that hasn't caught up yet, or that's a lag. And it's like, well, but it depends on what's driving this whole trade. If it's fundamentals, you can make a fundamental case for the price action. But if it's momentum, then they could all get swept up in it.
Well, yeah, I mean, if you didn't have silver doing what it's doing, gold also look a bit parabolic. It's about 35% above its 200-day. That is about as wide as we typically see for gold. You also are kind of around that even 5,000 number, which the round numbers do tend to have some psychological impact. So again, gold's up now the 6th day in a row. The last 5 days, it's been up over 1.3% each of those days. That's never happened in the gold ETF's history. So there's just a lot of signs that things are stretching the upper thresholds here. Again, we didn't think we'd be here a month ago, and here we are. But that doesn't change the fact that things are certainly overheated by technical standards.
Why do you think it'll be harder to call the top for gold than the other metals? And is part of that because of the different kind of parties that might be involved? Can you tell if it's central banks buying gold that's driving the price up right now, or is it kind of all sorts of financial market participants?
It's probably a mix, as it always is. I think if you look at some of the retail, where you can find data on retail, they're certainly heavily involved in both gold and silver. In the options market, you're certainly seeing that reflected as well. So, look, gold, like I said, I think if we take silver out of the equation, gold itself is certainly stretching the thresholds historically of what it's done. But it hasn't had the last month or so has not been quite as extreme, certainly, as silver. So I think they're both vulnerable here, but the downside probably is more in silver right now.
All right, Jonathan, thanks. Great to check in with you. Appreciate it today.
Thanks, Kelly.
Jonathan Krinsky with BTIG. Coming up, how AI is reshaping the workforce. We hear about that all the time. But this time, the call is coming from inside the company that ushered in AI. We'll tell you what OpenAI's Sam Altman sees ahead for hiring, particularly in the tech space. That's next. Tech layoffs are revving up again. Pinterest shares are down nearly 10% today after the company announced a restructuring that will eliminate 15% of its jobs. Meanwhile, Amazon is reportedly set to cut another 14,000 positions. Even AI startups are making changes, with OpenAI Sam Altman saying the company plans to dramatically slow down hiring. Is this a tech story, Deirdre, or is this back to our favorite ChatGPT versus now it's Claude? Now it's all about Claude. Are they just? Is this just a cute way for him to disguise the fact that they are laying people off?
You know, that's a really good question. Is this like an OpenAI thing, or is this a broader thing? Well, I'm going to argue that this is both, but it also tells us something really interesting about, you know, how we should be looking at AI at the moment. So the shift is interesting for OpenAI because, of course, it's not exactly known for its financial discipline. There's that. In a town hall, Sam Altman, he warned employees that aggressive hiring can actually be a signal of poor planning and a setup for layoffs once AI starts doing more of the work, i.e. what Pinterest and Amazon are doing right now. Now, this gets at a broader shift that investors should be watching closely, especially as big tech earnings gets underway. The next phase of AI, it's not just about expansion, it's about leveraging what you already have. So, for example, if CapEx continues to climb, investors should be asking how targeted the build-out is, what they're doing with what they've already built. They should also scrutinize utilization rates at those data centers and look for productivity metrics like revenue or free cash flow per employee rather than just raw headcount. In other words, who's getting the most out of what they've already spent or workforces that they have already cut? Anthropic CEO Dario Amodei, his essay that was published yesterday, it had a very practical point underneath the warnings, which I know got most of the attention, and it's this: as AI systems mature, the constraint shifts from building faster to managing and deploying what already exists. So that framework, that lines up with what Sam Altman is signaling here with hiring, and it's one that investors absolutely should be paying attention to over the next few weeks when we get big tech earnings. So, Kelly, it's a little bit of both. OpenAI needs to show some discipline, but AI as a whole probably needs to show some discipline, right? Show how they're leveraging what has already been built out with, you know, billions, hundreds of billions of dollars.
Yeah, I don't know. I like to remain a little hopeful. I think maybe all these new tools, I like, who was it the other day? Your friend over at DeepMind was telling, I think this was in a CNBC interview, said, you know, it's urgent that all young people learn how to use these tools, or anyone in the workforce right now, the way in which I really think there's going to be as much opportunity created from these tools as there are, you know, positions or people eliminated from it.
Right, Kelly, I know you'll enjoy this, but my kids went from asking for video game time to asking for compute credits. They've been spinning up their own apps, and they're looking at it saying, can I use your account because I ran out of credits here? And that's sort of like the shift, at least, that's happening here. I'm not saying the apps are any good.
No,
I'm just saying they're building them.
I let them use Microsoft Paint, and they make, you know, I help make some silly image, and then I put it in Gemini, and I say, bring this to life, right? It's silly, but now of course I can't get them to stop. But anyway, good problem.
Exactly.
Deirdre, thank you for now. Deirdre Bosa, appreciate it. Coming up, the Korea ETF is lower overnight after the president threatened to hike tariffs on some of its exports. But investors use that as a buying opportunity to gain exposure to Asia's best performing market. They've pushed the EWY ETF to a record intraday high. And with global trade shifting amid continued threats, we'll talk more about where to invest overseas next. Speaking of trade, don't miss the First on CNBC interview with Treasury Secretary Scott Bessent tomorrow at 10 a.m. Eastern on Squawk on the Street. Be glued to our TVs for that one. We're back after this. The mother of all deals. That's how India's prime minister described their new free trade agreement between India and the EU today. The deal, which has actually been decades in the works, represents about a quarter of global GDP and covers a population of nearly 2 billion people. It also closed on the same day President Trump says he plans to raise existing tariffs on South Korea for dragging their heels on a U.S. trade deal. But my next guest still sees big opportunities overseas. Here now with his international trades is Tim Seymour, the CIO of Seymour Asset Management and a CNBC contributor. And boy, did they pile into the Korean market, Tim. Welcome.
They did, and they've been piling into it all year. The EWY's, the South Korean ETF, is up about 25%. But we all know what's been going on in memory. And if you want the mother of all memory countries, it's Korea. And Hynix had an announcement this morning that they've got exclusivity on Microsoft's new AI chip. That's enough to send the stock up 8%. They're also just jockeying to see who can report earnings first on Thursday. They both report, and they've kind of moved it so both reports are at the same time. There's a lot of competition there. Samsung's up 35% this year. So if you want exposure to the part of the semiconductor trade that's been working for the last 3 months, a lot of it's in Korea. That's part of that story. But yes, it's a day when these global trade headlines that are inspired by fallout from Washington, or just changes that, as you noted, have been in the works for some time. There's a lot to do around the world.
Even as, and this is just crossing, but it's not a terrible surprise, but J.D. Vance has warned South Korea against targeting American tech firms, for instance, like Coupang, amid this trade escalation. So the temperatures are being turned, reportedly. We are seeing the temperatures turning up, but why are investors now ignoring it? It's sometimes you wonder why investors pay any attention to these headlines, and other times you wonder why they ignore them.
Well, first of all, South Korea has been a strong ally of the U.S. for a long time. And so much like headlines on Japan, I think people see the big political picture as such. I also just think that strategically it's going to be very difficult to move too far away from some of the capacity that Korea is giving us. So, and Korea is also very delicately positioned between the U.S. and China. I would say overall, as far as this global trade goes, we're talking about dollar weakness a lot this year. It's happening again. But I think the Asian currencies, notably the South Korean won, we've seen the Chinese yuan as appreciated, which is surprising given at times they've really fought that. But they are trying to get this reserve currency status. So there are politics. Obviously, the mother of all currency trades is the yen. And what's been going on there, I think also discussions, at least hints out of both Japan and U.S. that there could be intervention is enough to also push the dollar lower. That's part of this trade. It's a trade that I think will continue to work.
In 5 seconds, what does the EU-India deal tell you?
It tells me that Europe and India, but I love saying this because it shocks people. Europe's deregulation path is more extreme than the U.S. And I think it's fantastic for spirits. It's fantastic for textiles and whatnot. It's great for autos. It's great for investing in Europe. Take a look at that. I think it's important.
You have been, I meant to make sure that this needs to get out there in the public consciousness. You've been saying this, Tim. It's an excellent point. I appreciate you reminding us of that. Thanks for the time.
I appreciate the footnote.
Tim Seymour, thanks for watching The Exchange. I'll join Brian Sullivan for Power Lunch right after this quick break.
A new record high for the S&P 500 and the path to 7,000. A big week for your money. Big tech on deck. The Fed's decision on rates tomorrow. Welcome to Power Lunch, everybody. Alongside Kelly, I am Brian, leading your money and your market higher today. Technology seeing its best day since the middle of December, all as we await earnings from 4 of the so-called Magnificent Seven. Kelly.
Ooh, exciting. And it's not just tech that's working today. Money is also powering the cyclical trade higher. You don't hear about it as much, but energy and materials, new record highs. That's another area to keep an eye on. And that's where we start in the markets, with big gains in big tech helping to power the S&P to a new record as we close in just 18 points shy of that 7,000 milestone. Chips and memory names are leading today. Lam Research, Seagate, Western Digital, all of these are new all-time highs with moves of 5 to 6%. Investors are also closely watching the rate decision tomorrow out of the Fed, of course, and the mega cap tech results Brian referenced as fourth quarter earnings season moves along. Joining us to discuss it is Stephanie Guild, the CIO at Robinhood. Stephanie, welcome.
Hi. Nice to see you.
So I guess the question is kind of, it's a little bit ironic on the 5-year anniversary of kind of, you know, us being reminded what a force retail investors are in the market. What do you think is the biggest deal? You know me, my sympathies lie with it's the Fed. Even if they do nothing, maybe it's the Fed chair, maybe it's what they say, but maybe it is big tech earnings this week. What do you say?
I do think it's anticipation of big tech earnings. I also think that there's been a lot of, like last week we had some tumult in the market because of, you know, potential trade issues. And I think all that kind of stuff is starting to go away. I think you're also seeing some recovery in some of the software names, for example, that fell underwater because of thinking that AI was just going to completely take it over. So I think there's just some bouncing back. And the Mag 7 hasn't actually been leading this year. And so it makes kind of sense that people might be looking for maybe a little better value relative to other things.
Yeah.
And that obviously helps the broad market.
Where do you
too.
think you're kind of, you have the most conviction and you might be most out of consensus, and maybe those are not two of the same things?
Probably on a single name basis, we've been a little early, like we were a little early in the Lululemon, like some of the consumer names that we like that we think are kind of have recovery value, even if the consumer doesn't necessarily stay strong, although we have a positive view on that. And so in Robinhood Strategies, we started adding to it a couple of months ago. So in names like Lulu and even VF Corp is something more recently, because we think they're just down a lot, and there's definitely execution risk, but we think there's value in these brand names.
And we've got Starbucks, right, this week. I mean, a lot of these are kind of turnaround stories. It's been what do you make then? If the consumer is an area, and by the way, is this like an actively managed Robinhood vehicle that's okay, I see. So if you have like consumer confidence come out this morning and you're looking for a turnaround there, and then you see this number sink to 11-year lows, do you shake it off, or is that a relevant data point for you?
I guess it's relevant because you always want to care about how the consumer is feeling. But historically speaking, and I don't have the exact numbers, but I know for a fact that consumer confidence doesn't necessarily lead into lower stock values. And some of these names that we're investing in have micro stories, which is why I like it, because obviously there's always going to be a macro element that you can't control. But on a micro basis, if you're investing in a company that is, let's say, trying to just change the operations, make them more efficient, maybe expand margins, pay down debt. And we've seen some of that in some of these names. So I feel like there's just that is to me going to be a little more rewarded this year.
Yeah, you mentioned a name like a Cognex, which gets no love in the AI space, but all these barcodes, we probably have something we're going to scan with a QR code on our screen during the show. We're scanning everything. Cognex is not only learning from that information, it's helping companies get smarter, but yet Kelly, I don't think it's a name we've
never heard of it.
We've talked about ever, maybe.
It has a really solid business. It's been very consistent. As you say, it gets used in a lot of things. The reason why I like it is because you have, to me, like the ballast of that business, but then it also is learning for the future of robotics. Like it can become the eyes and maybe even the ears of, and the sensors of, future robots. And so this was just, to me, kind of like a nice, solid way to play that potential future.
Well, literally as you said that, or as we said that, and we'll give ourselves credit, the stock was down a touch. It's now moving higher. On your words, Stephanie. That's the real time. And by the way, the power of CNBC and Robinhood. And I think this goes to investor interest, okay? Because I gave a talk yesterday in Las Vegas, about 1,100 people, and they were all, interested in the market. And the level of interest is at a level I'm not sure I've seen in 20-something years.
Wow.
I love it. It makes me a little nervous as sort of a natural contrarian. But I know that you guys on Robinhood, your platform is seeing incredible volume and attention. What are you seeing and hearing from your own data?
Yeah, we have seen, we definitely saw a little bit of a lull, I'd say, in the fourth quarter in terms of net buying. But we have seen that pick back up pretty strongly in the last few weeks. And I've seen our customers continuing to do what they do in the single name basis, which is sell some of the things that are doing well, or at least trim them around those core positions, and then enter things that may be down a little bit. So we saw our customers starting to, make some moves across the software space that had been, underwater. A lot of those names are down 30-40% over the last 3 months. The other thing that we've seen is them picking up on this metals trade, right? So silver ETF, gold ETF, that's been there for a little while, for the last few weeks. And it's been really interesting because last year gold was on fire, and we didn't see that as strongly as I've been seeing the silver trade this year.
Right. I was actually going to ask Stephanie, as much as we're trying to make the case for Cognex, I mean, how many people on your platform are just, leveraging into what is happening here? I know anecdotally that this has captured the retail investor's mind and heart, because if you even approach this topic on social media, you get a firestorm. It's all about the dollars crashing and metals are flying. And, so is that kind of stealing some, traffic from those core stock areas of the platform?
I'm not sure if it's stealing it necessarily, is that it's just like part of the evolution of how we see our customers trade. We've been seeing them use ETFs to get invested this way. And so I think it's just part of picking up on the trends. I also think there's like a play here where under the hood, when you look at like the most, 100 most active and most owned, there is a play on robotics. There's a play on quant computing. And I think silver is kind of like in there. If we're going to build things, you need metals. And I think there's like a third leg to it too, which is like they kind of see this long-term secular aspect to it.
Yeah. For now.
It's fascinating.
Until it implodes. We'll see.
So are you making a call, Kelly, until it implodes?
But that was a big reversal in silver yesterday, Stephanie.
Yes, absolutely. Yeah. I mean, it's going to be it's momentum traded, so it's absolutely going to be something that's going to have higher highs and maybe even lower lows. But I think there's one thing I always say in this market is that I think the volatility is going to be higher, and you definitely want to trim some winners.
Well said. Stephanie Gilda, Robinhood. Stephanie, thank you very much. Two quick things on that I want to add. Number one, part of the talk I gave yesterday was that in a midterm election year, which is this year, we tend to get a 17% move in the market, so it's more volatile than normal. And did you see I know you're a big AI person. You see Dario Amodei of Anthropic's white paper yesterday, basically warning that AI may not be what we thought it was. That was, from a market perspective, that's scary. It was a scary paper to read.
I can't say I've dived in yet. I observed that he
TLDR? Too long, didn't
Let me
read.
ask AI what his
I was on a plane, so I had nothing else to do. A very long flight back from the West Coast.
He's positioning himself as a skeptic of AI. Look, Claude has really taken a lot of the market momentum lately, and I think that is the most significant thing that's happening.
Yeah, and I've said this I'll be on the record. I think the biggest market risk is some kind of crack in AI. If there's any slowdown, we could be in for a big drop. All right, let's talk Federal Reserve, because some, fascinating, crazy stuff coming from our Mock Fed panel. What is the Mock Fed? Well, it's a group of pretty smart market types who vote, doing air quotes, for their own Fed funds rates. And listen to this. Our panel is split. 3 of our members, Kelly, voting for a 0.5 percentage point rate cut. 4 members are opting to leave rates unchanged. There's nobody at 0.25%.
How do we have a mock Fed where 3 people want a 50 basis point rate cut? This is a motley crew. And I think who are we going to talk to tomorrow? Maybe we talked to Julia earlier today. She said she'd be sympathetic to a cut or two, just not at this meeting.
Yeah, just not at this meeting. So 4 of our mock Fed, the more traditional economics types, they're on hold. David Zervos, Bill Lee, a real estate guy, and Don Peebles, also a real estate guy. So 2 of the real estate-ish guys are looking for the cuts.
And you know what? Zervos would love that because he just had a piece this week where he was saying, again, reminiscent of the first Trump administration, that this is a lot about empowering kind of the people on the street over the academics. Remains to be seen whether that will fully infiltrate the thinking of the FOMC.
Oh, speaking of the FOMC, we've got the Fed's actual decision tomorrow right here on Power Lunch. As always, 2 p.m. Eastern Time. You'll be joined, not us, you'll be joined by our all-star lineup of guests, Jim Caron, David Kelly, Francis Donald, and Jeff Kilberg. They're all going to break down that decision from a very smart investor, economic, and even sort of trading take.
We'll be watching silver. The S&P may be up, but the Dow is down almost 1% today, largely due to this mystery component. If you can't guess it, just turn off your TV. We'll have a lot more on this incredible story after the break.
All right, some major news rocking both healthcare and healthcare stocks. In a surprise move, the Trump administration proposing basically no change for most Medicare Advantage payments. The plan calls for a net average payment increase of just 0.09% next year, basically nothing, and well below Wall Street expectations. That means the major insurers that get paid back by Medicare Advantage are getting absolutely pummeled right now. United Health down 20%. Humana down 19%, worst day in over a decade. CVS, Centene, and Elevance Health all down between 10 and 14%. So on this rather shock Trump proposal, and it is a proposal, has the health insurance space become uninvestable, at least for now, or maybe a big opportunity to buy the dip? Let's ask Mizuho Healthcare Equity Strategist Jared Holes. Jared, proposal doesn't necessarily mean it will happen. There are negotiations. How do you see this from an investing perspective?
Well, thanks for having me. I mean, it's certainly been a precarious place to invest over the past couple of years. Yes, I think, as you said, Brian, it's a proposal. There could be a final ruling, which is supposed to take place in April, so a couple months from now. And maybe that edited or revised ruling is a little bit better. I think this is just a shock to the system. I think investors had been positioning long, thinking this was going to be a turnaround year. And I think the headlines last night and some of the earnings that we got today obviously delay that dream for a little bit.
Delay or end the dream? Like, how do you see this ultimately playing out?
I mean, ending seems pretty severe. I think we're just going to be in a pocket now for a year, maybe two, in which earnings don't expand or grow as much as investors or the street had thought. So ending seems a little bit draconian, but obviously in a world in which so many other stocks and subsectors are working incredibly well, this is going to be a tough one for a bit.
I also, here's I don't follow, Jared, and both Stephanie Link and our guest last hour made this point. If the economics don't work for the business, what are the companies going to do? You know, the analyst last hour suggested they might reduce their footprints, that it won't necessarily be great for those relying on Medicare Advantage and so forth. But I mean, so what's going to happen now?
Yeah, Kelly, that's right. I think no one knows exactly what the blueprint is going to be for the industry. I think we've already seen a little bit of this take place. We've seen cost cutting take place at some of the larger insurers. We've seen benefits being reduced. We've seen a very active shift away from some of these Medicare markets because of the volatility around the rate environment, and also what's become increasingly difficult to predict as far as patient trends. So either way you slice it, I think we're setting up for, several steps that have to take place. I think benefit cuts is probably the biggest impact on a societal standpoint. But on the other hand, that's what's probably going to help earnings a little bit too.
Yeah, I guess the percentages of these companies that get their payments back from Medicare Advantage. And I want to be clear because this is is it fair to say, nebulous world. I've got a friend of mine who's probably watching right now, hello, John, that is sort of an expert in this, but there's about 10 people in the country that seem to know what they're talking about around this issue. How much of a payments issue is this for your coverage universe? In other words, does it mean a little bit for some companies and a whole lot for others? I assume the market knows, and that's why we're seeing some stocks down 19% and others down 10%.
Yeah, I mean, nebulous is one way to put it. I agree totally with that.
Scary.
Sure, all of the above. All those synonyms make sense to me. I think I probably used some in the past. I'm certainly not enough of an actuarial expert by any means as someone who looks at all the stocks within this sector to really have an incredible sense of, to the dollar, what it means for every company. I think when you showed the list of stocks sort of preceding this segment, that's kind of the way the street is viewing the impact. So I think Humana and United are impacted the most. Then it's CVS, and then it sort of cascades down from there. But yes, I think what investors are trying to do is look at the net impact, and the stocks are following suit there today.
It's going to be a big impact. It's one of those days where you watch the market action and you go, we're going to be hearing so much more about this in even 6 or 9 months from now than we even are today. Jared, thanks. As investors try to price that in, Jared Holtz. Let's get over to the bond markets now for a quick check. The 2-year yield under a little pressure after that weak consumer confidence report. It came in at the lowest since 2014, and that's around 357. 10-year a little more steady today, around 423, but the slide in the U.S. dollar continues. It's down 10% or so in the past year, and today it touched its lowest level in nearly 4 years, just a hair above 96. Rick Santelli in Chicago with more. Hi, Rick.
Hi, and everything you said is exactly correct. I would take exception with one thing. Yeah, we're down a little bit at 357 in a 2-year. We've seen 357 over and over and over in the low 420s and 10s over and over. We are in a very, very tight range. Now, let's look at that 10-year, actually 11-year low in consumer confidence going back to 2014, 84.5. Look at that chart. Okay, now let's look at the S&P 500 for the same 10-year period on a monthly chart. They don't look very similar, do they? And therein lies a big problem, in my opinion. Now, let's look at 2s and 10s. Kelly was exactly right. You see the low yield there? Right around 10 o'clock. Yep, right when the data hit. The markets understand. They made the low. Then they moved beyond it, and now we're right back in that range. And the dollar index? Well, let's look at a 1-week chart of the dollar index. You can see it sliding there. Now, before I show you what that other line is, you can probably see it's the dollar yen. And you're probably thinking, why would he put the dollar index and the dollar yen on one chart and think they're going to look different? I'll give you a reason. Because the yen is only 13.6% of the dollar index. It's having a very outsized effect on the dollar index, as are Japanese interest rates having an outside effect on global sovereign interest rates. Let's keep our eye on the ball, because if you're watching the Japanese markets, you're pretty much getting a lot of answers to our markets. Brian, back to you.
All right, good stuff. Back to Japan. I love it. Rick Santelli, thank you very much. All right, folks, you know this. Metals, they are hot. They have been hot. But is now the time to really be selective about the metals you own? Jim Cramer yesterday making a good call saying maybe it's time to sell the family silver, and silver turned around. We'll talk more about it in Market Navigator coming up.
Welcome back to Power Lunch. Dom Chu is standing by with a look at Market Navigator on a bifurcated market day, Dom.
Absolutely bifurcated, but one place that we're looking at, of course, is the metals, right? Silver and gold get most of the attention, but should you be chasing after the typical stars of that area of the market, or are there better ways to play that entire metals complex? So joining us now with that is Matt Rowe. He's the Managing Director of Solutions over at Man Group, which is, by the way, the world's biggest publicly traded hedge fund. So, Matt, we talk about that parabolic move in silver. We're watching that gold trade continue to move higher. But you think that there are better ways to play the metals complex. Take us through why and whether or not you are going to stay completely away from gold and silver.
Well, thanks. Just to avoid any confusion, I was on about a month ago with one of your colleagues, Joe Kernan, and my answer was different then than it is now. And I can explain a bit why, but I think the main thing to focus on is relative value. And you look at what is driving the move up in metals broadly. Over the last 4,000 years or so, a small data set, the gold to silver ratio has been somewhere in the range of 3 to 1 and 10 to 1. Since 2008, it's been somewhere in the 40 to 1 to 100 to 1, trading a little over 100 to 1 just at the end of last year. So when I was on with Joe about a month ago, the ratio was close to 80 to 1 gold to silver. Since then, it has collapsed to 47 to 1, driven by an outperformance in silver. What all of that says to me is that you can't ignore commodities. They are a absolute player in the market right now. As far as a diversified portfolio goes, I think you'd be remiss to omit it. But I think where you play has to have a lot of relative value situational awareness to it. And a month ago, my contention was that you should be long a basket of silver and platinum as opposed to owning gold. At this point, now that that spread has collapsed and reverted to the degree that it has, I think I agree with your colleague on maybe it's time to sell the family silver. And if you need to be long commodities to any degree, revert back to gold. I think playing the spread is going to be a smart trade.
All right, what about other parts of the metals complex? Are you looking at other places like, say, the platinum group metals or even the base metals?
Yeah, absolutely. I think platinum, molybdenum, cobalt, even down into the more obscure areas, I think those are important places, especially where you see industrial utilization having a sort of an anchoring effect to the valuation. Obviously a lot of the push into gold primarily, but precious metals broadly have to do with the fact that they trade on a basket of currencies. They're not dollar-centric, so I do think that there's some de-dollarization aspects to this trade. There's a historically significant attachment to value, particularly with gold, but silver as well. And I think the market kind of woke up to that over the last year. And you also see it as an inflation hedge, right? It's debatable how impactful it is or how useful it is as an inflation hedge, but certainly that's part of the narrative.
All right, so the interesting part about diversifying to a basket of metals versus just gold or silver. Matt, thank you very much. We appreciate it. Matt Rowe over at Man Group. And Brian, I'll send things back over to you.
All right, Dominic Chu, thank you very much. Molybdenum with the atomic number 42. Coming up, jury selection beginning for a huge lawsuit against social media. Are they the new cigarettes when it comes to addiction? That story ahead. Oh, we've got a news alert on AI startup Anthropic, a company we talked about at the top of the show. Kate Rooney has more. Kate, what's going on?
Hi, Brian. So I'm hearing that Anthropic has closed an initial funding round above its original target of $10 billion. This is according to sources familiar with that ongoing deal. So the valuation, $350 billion from what I'm hearing. That is pre-money. So before this investment, sources now telling me there is expected to be a second add-on as part of this financing, which could actually lift the total closer to $20 billion. All of this is ongoing, though. That second part would be an investment from Microsoft and NVIDIA. They had previously said they'd commit up to $15 billion, so unclear of how much of that is actually going to come through in this round. Have confirmed from sources it's being led by GIC, that's Singapore's sovereign wealth fund, Coatue as well, and Sequoia, interestingly, is participating according to a source. They are also an OpenAI investor as well, but at these levels, it would be double the amount of money Anthropic initially set out to raise. And a sign of all-out investor demand we are seeing for this AI startup. It has been getting a lot of buzz for Claude Code and its enterprise business. The deal, I'm told, could be finalized in the next few weeks. No comment from Anthropic, guys.
Well, sorry, Kate. I don't want to put you on the spot. Top of the show, we kind of off-the-cuff referenced this white paper that Dario Amodei, the head of Anthropic, had come out with. Is it getting any buzz out where you are? Because it's a pretty scary document, basically kind of admitting that AI may not be what we thought it might be in 2 years. Pretty telling from a company with a valuation of $350 billion.
Yeah, 100% getting so much buzz, and it is sort of the other side. I would say almost the underbelly of this AI race. We talk so much about the financing, the hype from investors, but there are real-world impact. I thought his comments on the economy, what could this do to jobs and unemployment, are fascinating, something to watch. He's obviously an expert here. They have really sort of tried to highlight the safety side of this and the risks. And, there are just two sides of this. There's the all-out race to compete. They're competing with OpenAI and others, but also trying to make sure this is safe on a global level. I think there's a lot of fear around this, too, that people are saying, yeah, on one hand, a lot of money here, but guys, here's the real-world impact that people are starting to pay more attention to.
And I think almost more or as significantly, the shares are up a lot in value. I mean, this is a huge fundraise round, and they're doing this on the back of momentum with Claude Code, and hats off to them because it's really garnered a lot of adoption. Kate, thank you. Kate Rooney.
Thanks, Gal.
Let's get to some other tech news. Meantime, a landmark social media trial kicking off in Los Angeles. It involves the addictive and negative impacts of social media on teens and kids. And some power players are in the spotlight. Let's bring in Julia Borson with more on today's developments. Hi, Julia.
Hi, Kelly. That's right. I'm here at the Los Angeles Superior Courthouse where jury selection is underway in this trial about the addictive negative impact of social media. The co-defendants now are Meta and Google's YouTube. After just this morning, TikTok settled after Snap settled